Now, you've probably come across this hawk-dove distinction in the context of the Fed. Hawks, these are Fed officials who really hate inflation. They want to conduct monetary policy to bring inflation down or keep inflation low and stable. Doves, on the other hand, they really care about unemployment. And so they want to conduct monetary policy in order to promote employment, to keep unemployment low. The thing is that very common, popular conception really only makes sense in the context of this naive Phillips curve view, this old view that economists used to hold, but not so much anymore. That naive Phillips curve view maintains that there's an exploitable trade-off between inflation and unemployment, that there is a menu of policy options, that the central bank can achieve low unemployment by accepting a high rate of inflation, or low inflation by accepting a high rate of unemployment, that they can just choose where along this Phillips curve that they want to be. So where did this idea come from? Well, the seed of this idea really came in 1958, where A.W. Phillips found a negative relationship between the growth rate of nominal wages and unemployment in the United Kingdom. But it's really in 1960 when two economists, Paul Samuelson and Robert Solow, find a negative relationship between inflation and unemployment, which they called the Phillips curve. And it's Samuelson and Solow who said we could treat this as a menu of policy options, that we could just choose where on that Phillips curve we want to be, and well, that's where we would be. But not everyone found this persuasive. Most notably, in 1968, Milton Friedman delivered a presidential address to the American Economic Association where he argued that there is no exploitable trade-off here. There's no menu of policy options. And in fact, that when you start to try to exploit that relationship between inflation and unemployment, that relationship will break down. Now, if you're a student of history, or if you lived through the 1970s, you know how this story goes. In the 1970s, we experienced very high rates of inflation, also high rates of unemployment. So it looked like that relationship there did, in fact, break down right after we attempted to exploit that relationship, just as Friedman had suggested. Now, you can't really fault economists in the 1960s for adhering to this naive Phillips curve view. If you just went to the data in the 1960s, you would see what looks like a negative relationship between inflation and unemployment, and you have two very prominent economists, Samuelson and Solow, saying you can exploit this relationship. But here is what that relationship looked like thereafter. There's no Phillips curve there. We do have a Jabba the Hutt showing up. No exploitable relationship between inflation and unemployment. Now, modern economists still have a Phillips curve in their model, but this modern Phillips curve view is very different. This modern Phillips curve view maintains that the position of the Phillips curve is not fixed. It depends crucially on inflation expectations. And it maintains that there's a natural rate of unemployment, a rate of unemployment towards which the economy will tend at any particular point in time. Consequently, there is no exploitable trade-off between inflation and unemployment. If the central bank tries to deliver lower unemployment by raising inflation, the public will just adjust their inflation expectations, and we will end up with higher inflation and no lower unemployment. So here's the key takeaway from that modern Phillips curve view. A central bank can deliver any rate of inflation it desires, but it cannot sustain an unnatural unemployment rate. Now, what does this mean for monetary policy? Well, in theory, a central bank can deliver optimal monetary policy in one of three ways. It can target the natural rate of unemployment, it can target the desired rate of inflation, or it can do some combination of the two. Now, in fact, calling this three ways is a bit misleading. I'm sure many of you have booked an Uber. When you call an Uber, you could put your address into the Uber, tell them where to come, Or you could put your coordinates into Uber, your geographic coordinates. And in either way, that car is coming to exactly the same point. And here, when we say there are these three ways, we're saying much the same. The natural rate of unemployment and the desired rate of inflation coincide. So it doesn't matter whether you're targeting one or the other, at least in theory, or some combination of the three. They're all pointing to the same point. That's what macroeconomists today refer to as the divine coincidence. And that works well in theory. But in practice, what the central bank targets can make a big difference in how well monetary policy is conducted. Let me explain a bit why. That natural rate of unemployment, well, it turns out that's unobservable. We don't know what the natural rate of unemployment is. And there's no reason to think that the natural rate of unemployment is the same each period. So that natural rate of unemployment is both unobservable and unstable. So if you're targeting the natural rate of unemployment, you've got a pretty big problem. You're trying to hit an invisible moving target. Good luck with that. How about the desired rate of inflation? Well, the desired rate of inflation is observable as a long-run objective, but in the short run, inflation should rise and fall to reflect temporary changes in productivity growth. And it turns, sometimes you'll hear Fed officials refer to this as looking through supply disruptions or looking through supply shocks. The problem is that it can be pretty difficult in real time to figure out why inflation is rising or falling. Is it driven by changes in supply or driven by changes in aggregate demand? All right, how about that combination of the two? Well, when considering optimal monetary policy, macroeconomists typically assume that the central bank is adjusting its nominal interest rate target with some Taylor-type rule in mind. And without getting into all the details, what that means is that they're going to adjust their nominal interest rate depending on what's happening to the inflation gap and the unemployment gap, where the inflation gap is the difference between the prevailing rate of inflation and the desired rate of inflation, and the unemployment gap is the difference between the prevailing unemployment rate and the natural rate of unemployment. And there's some debate about how much weight we should put on the inflation gap or how much weight we should put on the unemployment gap. What I want to stress to you is that academic debate about how much weight to put on what is not about whether we care about inflation or unemployment. Remember, whether we're targeting inflation or targeting the natural rate of unemployment, those are headed to the same position. This is a question of effectiveness. How do we set these weights so that monetary policy is actually likely to get us to that point, so that that Uber actually shows up to our house? That is the relevant question here in determining whether we should care more about inflation or unemployment when setting these parameters. But there is another way. Rather than targeting an average of inflation and unemployment, an average of those gaps, a central bank might target a nominal spending gap. That is, the difference between actual and desired nominal spending, or nominal GDP. And it turns out that targeting nominal GDP has several advantages. It lets the central bank achieve its desired inflation rate in the long run. It lets inflation reflect productivity shocks, temporary productivity shocks, because inflation and real GDP growth necessarily move in opposite directions if you're hitting your nominal spending target. It keeps the unemployment rate at the natural rate of unemployment. And it also has this financial markets effect where it tends to distribute windfalls more equitably in nominal contracts. So when it comes to making sense of the mandate, I think the Fed could do a whole lot worse than thinking about achieving that mandate by targeting nominal GDP. Now, Peter and Alex are going to say a bit more about targeting the mandate, about the Fed's mandate. If you're interested in hearing more from me, I have a weekly newsletter that goes out on Monday, totally free, and you're welcome to follow along. Thanks a lot.
Thank you you will. We will invite Peter Ireland up to the stage now, but I do highly recommend the newsletter. It comes out like 6 a.m. Monday morning. He's hard at work Sunday night, getting it ready for you. It's got great stuff.
Okay, thanks, Lydia, and thanks, Will. I'll subscribe to the newsletter, too. So I actually have a short paper as opposed to a newsletter that provides a little more by way of detail and background on the topics that I'll be discussing today. If you are interested, you can find it on my webpage. The URL and the paper title are the ones shown here. But just to summarize, the paper argues first that the statutory dual mandate is likely to be with us for the foreseeable future. I agree very much with Brian Cutzinger from earlier today. It would be great if Congress would step in and streamline the mandate to focus the Fed's attention on stable prices. There have been multiple attempts to achieve that in the past. They've always failed. And I'm simply taking a sort of empirical view of this. Those efforts have not panned out in the past, and I don't really see anything changing in the future. All that said, economists' interpretation of the dual mandate, and this goes back to Will's presentation, economists' interpretation of the mandate and how to achieve it has shifted considerably over time, reflecting, again, as Will indicated, a gradual evolution in our understanding of the nature, sources, and implications of the statistical Phillips curve, by which I mean the tendency, in at least sometimes in places, for inflation and unemployment to move in opposite directions. For academic economists, the story is very much one of continual scientific discovery, or if you prefer, just more simply, learning from experience. At the Fed Reserve, though, not so much so. Now, Will did a great job of summarizing the history of economic thought when it comes to the dual mandate and the Phillips curve. So I'm going to skip over these next few slides, which are largely a rehash of that, and jump right into what I think a lot of people came here for today, which is blistering criticism of the Fed Reserve. Okay, but before I get there, partly out of fairness, and also to anticipate where I'm going to come down at the end, I want to emphasize that the story here is not 100% critical, and the story is not entirely grim. Because if you go back to the year 2012 and the original statement on longer run monetary policy goals and strategies released by the FOMC that year, the first strategy statement of its kind, it strikes me that that strategy statement actually does a very, very nice job of encapsulating and responding positively to exactly the lessons learned from theory and history that Will emphasized just a moment ago. So, for example, setting a numerical target for inflation but not unemployment. That's the natural rate hypothesis. The Fed can pick out any target it wants for inflation and hit it with a fair degree of accuracy over the intermediate term. It simply cannot do the same with unemployment. Acknowledging that the two sides of the dual mandate are largely complementary. That's just a restatement of what Will referred to as the divine coincidence. Now, Will did a nice job of summarizing how I think an academic economist would define, if you will, that term divine coincidence. But for me, there's an underlying hard core of truth in that mathematical result. And what the truth behind the divine coincidence says is this: by aiming to stabilize the inflation rate first, the Fed Reserve can create an ideal environment of monetary stability within which the private sector, right, then produces maximal growth in jobs. So price stability is the road through which we achieve maximum employment. There's no trade-off or conflict between the two sides of the mandate. And then third and finally, the 2012 statement prescribes a so-called balanced approach in circumstances where the divine coincidence breaks down. I talk a little bit more about this in my paper. I interpret that phrase, balanced approach, as learning from experience. Throughout the 1970s, repeatedly, the US economy was hit by adverse non-monetary shocks, most famously sharp increases in the world price of oil, that by themselves did increase the measured rate of inflation and also increased unemployment. But then the Fed Reserve would respond with excessively accommodative monetary policy that did precious little to bring the unemployment rate back down and instead just pushed inflation higher. So the balanced approach, that's an implicit promise by the FOMC not to repeat the mistakes that gave rise to stagflationary outcomes in the 1970s. So if everything started out so well, where, when, how, why did things go off track in the years since then? Well, this part of the story we're all familiar with because we just finished living through it. In 2019, the FOMC conducted a major strategic review that culminated in 2020, the year after, with the release of a heavily amended strategy statement introducing flexible average inflation targeting. On the surface, flexible average inflation targeting appeared as a perfectly reasonable solution to a very real monetary policy problem, namely the problem of the zero lower interest rate bound. Specifically, the idea was that if the ZLB was going to prevent the Fed from delivering sufficient monetary accommodation or stimulus during recessions, then just allow policy to be a little more expansionary during the recoveries that followed, just to make sure that inflation averages out to equal 2% over the cycle as a whole. Perfectly reasonable, and again, as I discuss in the paper, this was an idea that was also analyzed extensively and approvingly in the academic literature in the years leading up to the 2019 review. Problems with flexible average inflation targeting came in entirely through the details with which flexible average inflation targeting was described in the 2020 strategy statement, all of which were heavily biased in one direction towards the creation of additional inflation. So, for example, calling for makeup after undershoots of the inflation target, but not makeup after overshoots, just raises the basic question: is this strategy really going to succeed at stabilizing average inflation at 2%? The 2020 strategic statement also contained language that appears to elevate the Fed's goal for unemployment above that for inflation, contradicting the implications of the ideas and experiences that Will mentioned just a moment ago: natural rate hypothesis, the divine coincidence, and the painful experience of the 1970s. And then third, finally, and maybe most mysterious of all, 2020 statement also dropped the language about the balanced approach, just begging the question: if the approach is not balanced, what is it? So just to be fair and just to be clear, I don't think anybody could possibly have anticipated the bizarre chain of events that unfolded in our country beginning in March 2020. That said, I also think it's fair to observe that throughout most of the post-2020 period, the Fed's been operating with a monetary policy strategy that's heavily skewed towards the creation of additional inflation. And so it can't be regarded as an accident that high, persistent, unwanted inflation is what we've ended up with. Now, where do things stand now? Last year, the FOMC conducted another strategic review, which culminated in the release of another amended strategy statement, which once again on the surface seems to do exactly the right thing. It jettisons the flawed flexible average inflation targeting framework and appears to return to the sounder principles originally outlined in 2012. The details of the new strategy statement, however, continue to raise concerns. And what's more, this is interesting. I loved your talk earlier today, Tyler, but this kind of gets at what Mike was asking Tyler about at the end of that first session. If you go back and you take a look in particular at the speech that Fed Reserve Chair Powell gave at last summer's Jackson Hole Conference, it's very hard to come away from that speech without the strong suspicion that the 2025 strategic review was actually not a serious strategic review, in the sense that I don't think FOMC members ever directly confronted the experiences post-2020 in a way that would prevent them from making the same mistakes all over again. Let me illustrate with a couple of excerpts. Here's one excerpt from the speech where the chair first appears to take great lengths to excuse the Fed from any direct role in the inflationary surge we had in 2021-22, and yet, a minute later, he's taking credit for the decline in inflation that we've had since then. And here is another excerpt from the speech where he blames the problems on communication issues. It's definitely true that FOMC members struggled to communicate with the with the public post-2020. But rather than being a fundamental source of the inflation that followed, it strikes me those communication issues are just another symptom of having a monetary policy strategy that was heavily biased, or maybe you might just say incomplete and vague, but in any case, in ways that FOMC members never really wanted to publicly admit to. And then if you take a look at the details of the new strategy statement, especially when compared to the original 2012 version, whereas the 2012 statement begins by introducing the 2% inflation target and then goes on to talk about goals for unemployment, the new statement reverses the order. Second and related, the new statement continues to feature language similar to what appeared in 2020 that also appears to elevate the objectives for unemployment above those for inflation. Again, contradicting the lessons learned from the natural rate hypothesis, the divine coincidence, and the painful experience of the of the 1970s. And then third and finally, while the new statement does reintroduce the language about the balanced approach, it still concludes with language that strongly suggests that FOMC members just can't let go of the old-style view of the Phillips curve that Will mentioned at the beginning of his presentation, the view that sees the two sides of the dual mandate as a trade-off which can be managed via the Phillips curve by skillful fine-tuning. To be clear, this is an approach to monetary policy making that's led to serious inflationary problems in the past, in the 70s, and again post-2020. To the extent that committee members cling to the belief today, they're going to be vulnerable to similar mistakes in the future. So to conclude, what's the way out of this mess? Well, one possibility might be to just do what the FOMC failed to do last year, which is to take a cold, hard look at the post-2020 experience and then fix flexible average inflation targeting, or maybe come up with something entirely new and better. Nominal GDP targeting, like Will just mentioned and like Alex is going to talk about in much more detail coming up. Just to be clear, I fully approve of that idea. Okay, my only hesitation, it goes back to my interpretation of what happened at last year's strategic review. To see this, suppose that we take a step back and try to give the Fed the benefit of the doubt and come up with a more charitable interpretation of what went on last year. I think we could do that by saying that maybe last year in 2025, FOMC members realized that they really couldn't do any better than what they already had in 2012. And that's not a put down, by the way, because the 2012 statement, as I said, is really quite good. The problem, the sort of rhetorical problem with doing that, though, is if they simply dusted the old statement off, took it off the shelf and adopted it again, it might be interpreted by some as like an admission of the mistakes of flexible average inflation targeting post-2020. But here, I think, is where the arrival of a new Fed Reserve chair later this year provides a kind of way of finessing things, an easy way out, if you will. A new chair could come in a few months from now and just say, look, I'm new here. I need to learn about everything that's gone wrong and also everything that's gone right. Maybe going all the way back to 2012, maybe going all the way back to 2008, maybe going all the way back to the days of Volcker and Greenspan. But in the meantime, the new chair could emphasize that old proverb, right? Don't let the best be the enemy of the very good. The new chair could say what we had in 2012 was pretty good. It reflects the lessons of modern macroeconomics, the divine coincidence, the natural rate hypothesis. It reflects the lessons that we learned the hard way in the 1970s and relearned post-2020. I think that simple step, precisely because it is so simple and direct, stands a good chance of working. I think that that would be a step that would really work to improve monetary policy making in the United States right away. Thank you very much.
Thank you, Peter. Appreciate that. We'll call up Alex now. And the mic's working.
We don't want inflation. We don't want deflation. We just want inflation, whatever the heck that is. Those were the words of my late mentor, Tommy Coppage, when I took his undergrad macro course at the University of North Florida 20 years ago. The quip has stuck with me because it so cleverly and succinctly captures the challenge the Federal Reserve faces in balancing its price stability and maximum employment mandates. To help navigate that challenge, I'm grateful for the opportunity to discuss today a measure of economic performance known as the NGDP gap. First, though, I'd like to briefly describe what NGDP is and how it relates to the Fed's mandates and monetary policy strategy statement, which I'll refer to hereafter as the statement. Before going further, please note that the views expressed here are my own and do not necessarily reflect the views of the Treasury Department, the US government, or my co-authors. NGDP stands for Nominal Gross Domestic Product. It measures the quantity of dollars spent on final goods and services produced within a country's borders in a given year. And since every dollar spent is a dollar earned, NGDP conceptually represents both an economy's total nominal spending and income. The GDP deflator adjusts NGDP for inflation to yield real GDP, which better reflects the quantity of actual goods and services being produced. In relation to the Fed's mandates, the GDP price deflator is a measure of price stability, while real GDP relates to maximum employment, as more output generally requires more jobs. The real GDP analog to maximum employment is known as potential GDP. The Fed's statement specifies price stability as consistent with a 2% inflation target of 2% per year, while maximum employment and potential GDP, being unobservable, are left to the Fed's judgment. The general consensus among forecasters, including those at the Fed, is that potential GDP growth is roughly 2% per year. Note that in the longer run, 2% inflation plus 2% real growth implies roughly 4% NGDP growth. As the Fed statement conveys, the inflation rate over the longer run is primarily determined by monetary policy, while maximum employment and by extension, potential GDP is determined by non-monetary factors. In other words, an economy's sustainable productive capacity depends on the availability of labor, capital, and how productively these are employed, and not on monetary policy. In the shorter run, real GDP may deviate from potential, resulting in inflation rates that diverge from 2%. For example, real GDP in excess of its potential, or analogously, an unemployment rate below its natural rate, implies an unsustainable intensity of real resource utilization that is generally expected to beget rising inflation. And this is the underlying logic of the Phillips curve. Note the absence of NGDP from the story, but consider the unspoken reality of the situation. To get inflation to 2% in the longer run, the Fed must ultimately get NGDP growth to rise 2 percentage points faster than real GDP growth. Thus, using monetary policy to influence NGDP is important whether or not this is acknowledged. Furthermore, explaining inflation as a result of nominal spending rising relative to the production of real goods and services strikes me as far more intuitive than the Phillips curve logic, which places output and labor markets in between monetary policy and inflation. Even if one doesn't buy these arguments, suffice it to say and to know that NGDP encapsulates both the price stability and maximum employment mandates via the GDP deflator and real GDP respectively into one indicator. With this in mind, let us turn to the NGDP gap. The NGDP gap measures how far nominal income and spending deviate from what past forecasts expected. Hence the occasional use of the term expectations gap in some related applications. Those past forecasts are used to construct what Beckworth 2020 calls the neutral level of NGDP, which is calculated as a rolling 5-year average of NGDP forecasts for a given quarter. For example, neutral NGDP in Q4 2025 is the average of consensus forecast for that quarter published each month from January 2021 to December 2025. These consensus forecasts come from the Blue Chip Economic Indicators survey of roughly 50 professional forecasters. The intuition for a backward-looking 5-year average of forecasts works as follows. Suppose you take out a 30-year fixed-rate mortgage to buy a home in 2006, with you and the lender having some implicit path for your future nominal income in mind. As your nominal income grows and with inflation and your productivity, the proportion of your income devoted to your fixed monthly mortgage payments declines, thus easing your debt burden. Suppose, however, that 2 years later, your nominal income suddenly drops 10% relative to what you expected when you took out the mortgage. The increased debt burden compels you to reduce the dollars you spend on other goods and services, or worst case, to default on your mortgage. One could tell an analogous story for a firm that borrows to acquire capital and pay labor to produce goods and services, but does not earn the nominal revenues that were expected when the debt was assumed, thus compelling it to lay off workers, default on its debts, or both. The overall idea is that on an ongoing basis, new debts are contracted while old debts mature or refinanced such that they last an average of 5 years. This is admittedly a crude assumption, but reflects the idea that most nominal contracts roll over on a multi-year horizon. Therefore, if actual NGDP falls 10% relative to expectations, measured as neutral NGDP, households and businesses would cut spending to avoid becoming delinquent on debts. An economy-wide decrease in spending leads firms to reduce output, leading to some combination of higher unemployment, deflationary pressures, and financial stability. Indeed, the NGDP gap corroborates such an experience in 2008. Thus, a negative NGDP gap indicates downside risks to inflation, employment, and financial stability, whereas a positive gap indicates upside risks to inflation and employment, or the possible emergence of financial imbalances. Aside from the Great Recession and the global financial crisis era, the NGDP gap aligns with other major economic developments. It was positive during the late 1990s during the dot-com boom and bust cycle. It turned negative during the recession of 2001, and it turned positive during the mid-2000s when there was a boom and bust cycle in housing. In the 2010s, the NGDP gap closed very slowly following the 2008-2009 recession, matching the slow decrease in the unemployment rate. Moreover, it remained persistently negative, coinciding with inflation falling chronically short of the Fed's 2% inflation target. In contrast, following the pandemic-induced recession of 2020, the NGDP gap closed quickly, as did the unemployment rate. It then turned sharply positive as the rate of inflation surged above 2%. Well, these slides establish that the NGDP gap coincides with major U.S. economic developments. I'll now turn to its potential to provide real-time guidance to policymakers. The forward-looking NGDP gap compares the most recent forecast for the expected path of NGDP against forward-looking neutral NGDP estimates. For example, suppose it's December 2020. Sorry to bring you all back there. And we want to gauge what the NGDP gap for Q4 2021 is on track to be. In this case, the December 2020 blue chip NGDP forecast would be compared against the forward-looking neutral NGDP estimate for Q4 2021. The latter would be the average of 60 months of blue chip forecasts, 48 of which have been published between January 2017 through December 2020, and the 12 yet to be published forecasts for January 2021 through December 2021 simply assume expectations stay where the most recent blue chip forecast puts them. Thus, the chart shows how the forward-looking NGDP gap for Q4 2021 evolved as new blue chip surveys were published. For example, the forward-looking NGDP gap calculated for the data included with the December 2020 Blue Chip Surveys publication implied that NGDP was on track to undershoot estimates of neutral by 2.4% in Q4 2021. However, by the publication of the May 2021 Blue Chip Survey, the forward-looking NGDP gap clearly implied the economy was on track to overheat by year-end 2021. Indeed, this was the largest positive forward-looking NGDP gap value since before 2008. Most notably, it signaled the risk of inflationary pressures roughly 6 months before the Fed announced its intention to begin to tighten monetary policy. Turning to the 2010s, in which inflation remained chronically below the Fed's 2% inflation target, the chart shows various forward-looking NGDP gap vintages for the fourth quarters of select years remains deeply negative, despite the federal funds rate having been held near zero from December 2008 until December 2015. The 2015 series, which shows the forward-looking NGDP gap for Q4 of that year, started to deteriorate more rapidly in early 2015, coinciding with the onset of the so-called invisible recession, and with hindsight suggests that the December 2015 rate hike might have been premature. Lastly, looking at the 2019 series, it indicated that in late 2018, the economy was on track to overheat by year-end 2019. However, it turned negative in early 2019, and indeed, beginning in August, the Fed reversed some of its earlier rate hikes. So turning back to the Fed's statement notes that its employment and inflation objectives are generally complementary. That is, inflation and real GDP move in the same direction. This references demand-side shocks that can be measured by rising and falling NGDP growth rates. The non-complementary cases, in which inflation and real GDP move in opposite directions, references supply-side shocks over which monetary policy cannot control. Suppose, for example, there is a negative supply shock which increases inflation and slows real GDP growth. What is a central bank to do? Tighten policy and real GDP growth falls even more. Ease policy and inflation rises even more. A more balanced approach would aim to keep NGDP growth stable such that inflation and real GDP growth vary with supply-side developments. Indeed, I think this may be the inflation we've been looking for. Here, I hope the NGDP gap might help, where it is near 0%, or where the forward-looking NGDP gap implies it is on track to converge to 0% over, say, a 1 to 2 year horizon, suggests a policy that is calibrated to stabilize the economy's demand side, regardless of whatever supply-side shocks arise. An area where further investigation is needed is the assumption that averaging 5 years of historical forecasts with equal weight is optimal. That said, a forthcoming piece in the International Journal of Central Banking shows that the NGDP gap revisions are 2 to 3 times smaller than revisions to conventional measures of economic performance, such as output gaps. Moreover, while the latter rely on unobservable estimates of potential GDP, neutral NGDP is based on observable forecasts. In closing, regular updates to the NGDP gap can be found at the Mercatus Center at George Mason University's website. And thank you all for the opportunity to speak with you today.
Thank you very much, Alex. Well, now I'm excited. We get to dive into a few questions about this. Yeah, actually, would you hand me the clicker? Oh, awesome. I'm going to hire you now. Slide advancer. So to get us started in a little discussion before we turn it over to some audience questions, I wonder if we can go, we're going to talk more about NGDP targeting for sure. I want to take us back a little bit, maybe a little bit more to Will and Peter's conversations or presentations about the origins of the dual mandate a little bit, because it started, we actually got that mandate in 1977, which is exactly when we're actually experiencing stagflation and the breakdown in the Phillips curve, that there's this exploitable trade-off between inflation and employment, or unemployment rather. Why is it that something that was already breaking down not only became enacted into law, although I could probably answer that question having spent many years in Congress for a while, but why has it also continued just also within the profession? It's still a staple in the profession of there is this exploitable trade-off, and how should we be thinking about that?
Well, I'll let Peter talk about the history, and I'll talk a bit about why I think this continues in the public's mind. And to that, I think I have to admit that we're the problem. We are the problem because economists like me, we don't update our slides perhaps as often as we should. We don't explain to our students precisely what we mean by that Phillips curve, and I think that as a consequence of that, we've let this idea just linger on in the minds of our students without really stamping that out as it has been in the academic literature. I think that if we were a bit more clear there, and if we had been more clear for decades now, that there's not an exploitable trade-off, rather than just presenting this Phillips curve and perhaps not being as clear about it as we should, then it would be harder for journalists and non-economist policymakers to continue thinking that there's this exploitable trade-off. So I think there's a big communication failure there, and unfortunately, that's the economists in the classroom that should be doing a better job of that.
So we'll blame you. Gotcha. Peter, did you want to respond?
Right. In response to your first question, I don't know what the exact adage is, but the idea that generals are always fighting the last war, that's really a frustrating thing, and we see it happen again and again, I guess, in warfare, but in economics as well. The dual mandate was codified in 1977, just as the statistical Phillips curve on which the idea was based broke down. As I mentioned, the idea behind flexible average inflation targeting was perfectly reasonable, and when I heard about it, I think most academic economists said, yes, this is exactly what you do when you're confronted with the ZLB. You just make sure that you make up for past misses in a way that prevents, like Alex was saying, a circumstance where a bunch of single-sided misses each and every quarter, modest, but accumulating over a period of 5 years, really imposes financial hardship on people who have entered into longer-term financial planning. So this always seems like that. You look backwards, you try and fix the problem, but inadvertently give rise to the next problem. I guess what I would say about the idea, why do economists keep thinking this? I guess I'd like to take a more charitable view of economists. For me, this is, I mean it, this is like the hardcore of truth. We know this from experience, and we know this from theory. When a central bank successfully focuses on price stability, it allows the free market. Only the free market is capable of producing jobs, not the Fed. We know that's the way that it works. But it may be similar. Another example of this is rent control. We can say this to the public. Like, look, rent control, yeah, I get it. It sounds great. Then people won't pay high rent. But the thing is, then you point out, well, there are other margins along which you can adjust theoretically. And that is what landlords, what building owners are going to do. And then you say on an empirical level, do you know what New York City looked like in the 1970s and 1980s? Because of rent control, give me a break. It's very frustrating, but I would say I'm a little more forgiving than Will, perhaps, of academic economists. But I agree, we have to fight harder.
On the thing of rent control, what is it? One economist once remarked, there's no surer way of destroying your housing stock except bombing, I think. I thought that was can't remember which economist that was. So on the single mandate question, or rather the importance of price stability, there have been debates in Congress about potentially switching to a single mandate. There's even been a little legislation or some hearings talking about this. Is that something that would improve monetary policy? Can you each speak a little to, if the Fed is focused on price stability, how does that really help them achieve the outcomes that we're looking for, which is stable prices and hopefully relatively low unemployment?
Suppose there's this division that I see whether monetary policy is supposed to stabilize prices or if it's supposed to stabilize the nominal spending side of the economy and just lets the supply side determine what the resulting mix of inflation and output is going to be. So I think price stability might be barking up the wrong tree
Yeah, I guess, when I think about price stability, I typically think of it as a longer-term goal. The reason we want price stability is because if we know what the dollar is going to be worth in 2 years, 5 years, 10 years, it makes it much easier to plan over those horizons. It reduces the risk of long-term contracting. And this shouldn't be surprising to anyone who's familiar with history. At one point in the past, we were on the classical gold standard. That system, despite any flaws that it had, one thing that it did accomplish was tending to deliver a stable purchasing power of the dollar in the long run. And that's why we saw things like 100-year bonds. Kind of hard to imagine someone issuing a 100-year bond today. It's just too risky. You have no idea what the dollar is going to be worth in 100 years. So just forget about it. And it makes it a little harder to contract over very long periods of time. Whether or not moving to just price stability is an improvement, I think, depends in part on how that gets operationalized. If it's understood that this is a longer-term objective and that for short periods of time you want to look through some supply disturbances, allow prices to rise above trend when we are hit by adverse supply shocks and fall below trend if we have some burst in productivity, that's great. But if instead we find ourselves in situations like just after the downturn in 2008, where the chair of the Fed is sitting before the House Financial Services Committee and the Senate Banking Committee and is being told, well, hold on a second, you don't want to make this problem worse by delivering some inflation here, right? You're not going to let inflation go above 2%, precisely at a time when inflation had been below 2%, undermining people's expectations, and we needed slightly higher inflation to catch up to where people expected those prices and hits the purchasing power of money to be. I think that creates some problems. So much like Peter was saying, when the flexible average inflation targeting came out, I think a lot of us said, great, this looks good, but then how it was operationalized, not so much. It's only going to be making up in one direction, not super clear to the public that it was going to be doing that. So I think the devil is really in the details there.
So when it comes to nominal GDP targeting, it sounds like there are a number of merits to it potentially, where it allows the Fed to be able to continue focusing on its dual mandate of price stability and inflation. So would there need to be any change, or can they just maybe sort of rejigger their statement, their consensus statement of what their monetary policy strategy is? And is NGDP actually a superior way of helping them figure out how to achieve those targets, or are they doing a bang-up job?
I feel like the Fed is pretty adept at being able to pull the dual mandate in the direction it feels is the way to go. If you can make a good case for that a stable growth path, level path for NGDP is most likely to deliver maximum employment and price stability to the best extent possible, that argument can be made. I think it can be followed. Yeah, no, I do think it's a possibility and that it's one that should be explored, or at least in the worst case to look at other indicators, because this came up, Tyler referenced the Bernanke speech to Milton Friedman, and one of the things he said is you can check, one of the best ways to check for monetary stability is to look at inflation or GDP growth. So it's not like this is out of left field from some quirky economist like myself, but at least to keep your eye on that and how far it's traveling from what would be a stable trend. I think the NGDP gap can at least warn when you're really getting out of bounds potentially, and then you can still apply the standard framework that you have and sort of just use that as a guardrail, if you will.
I agree with everything Alex said, but actually I'm an even bigger fan of nominal GDP targeting, and one reason is exactly the one that you alluded to. Nominal GDP growth decomposes naturally into an equally weighted sum of real GDP growth and inflation. So targeting nominal GDP growth is trying to satisfy the dual mandate. It's fully consistent with the dual mandate. Second, like Will mentioned, aggregate supply shocks tend to move real and nominal magnitudes in opposite directions with muted effects on nominal GDP. So nominal GDP targeting also solves this problem of trying to look through the effects of shocks that are hitting the economy from the supply side. And then finally, and best of all, nominal GDP is a nominal variable. Unlike unemployment, where the Fed cannot possibly set a numerical target for unemployment, there's no question the Fed can set a target for nominal GDP growth wherever it wants. It can't hit that target quarter by quarter or even year by year. But when averaged over a period of 2 to 3 years, there's no question that the Fed can't hit any target for nominal GDP. So I think one of the great appeal of nominal GDP targeting lies in the fact that it's fully operational and fully consistent with the dual mandate, with all of what's expected from the Fed now.
One of the biggest criticisms of nominal GDP targeting has been that it is difficult to communicate, that the public won't understand it. Now, part of it may be due to these professors who have ingrained in so many of us this Phillips curve mentality. But even Chair Powell, in some unprepared remarks, some questions he was responding to, acknowledged the merit of targeting this nominal number and enabling them to hit their objectives. But his reply was, but how do we communicate this to the public? Would you guys have any thoughts about whether it can be done and how?
So I think this communications critique is wrong in two respects. First, it's wrong because it presupposes that the Fed is already doing a bang-up job communicating its inflation target. The reality is that most people don't really understand what the Fed is trying to do, let alone what it's trying to do with inflation. If you think in terms of, when there's a decline in aggregate demand and the Fed needs to engage in some expansionary monetary policy to push us out of a recession, the communication strategy there is not great. As I was saying earlier, the Fed has to go to the public then and say, well, I know we're in a recession, but I'm going to cause some inflation. And the public says, what? That sounds terrible. So that's not a winning communication strategy. But this communications problem argument is wrong in another respect, because it turns out that if you go to surveys of the public, they generally answer those surveys with a framework in mind, or at least what appears to be a framework in mind, that inflation and real GDP growth move in opposite directions. That is, when we're producing less, the public expects things to be more expensive. And when we're producing more, they expect things to be cheaper. So the beauty of a nominal GDP target from a communications perspective is that you don't have to first teach the public what they don't already know. Instead, you're really leaning into the public's beliefs. You're saying, the way you think about the economy is actually right, and we're trying to stabilize the economy so that we're not getting those big swings.
Yeah, I think, was it Peter who said that there's something intuitive about it? Any other thoughts?
No, I mean, I share the intuitive aspect. If people start spending more dollars than goods are produced, prices will rise. And I feel that's far more straightforward than saying, oh, if rates go too low, the unemployment rate falls, and that eventually creates upward pressure on wages, and then that leads to higher rates of inflation. I feel like the first description is a lot crisper. I am biased.
Any comments from you, Peter? You'll stick to your academic
Good
papers?
job.
Excellent. Well, it's now time. We're going to open it up to some audience questions. If you have a question, please raise your hand, and we will send a mic over to you. We have stunned you all into silence. This is amazing. Or I can't see from the lights. I see the gentleman here. I might even know him. Oh, please identify yourself, and don't forget to phrase your comments in the form of a question. They do end in a question mark, but.
Yeah, they do. So this related to the first talk this morning and to several of you. So would it help to have external reviews of the Fed's framework consultations? Because it
Yeah, that's an excellent question, Andy. To answer it, I guess I would give a two-part approach. Sure, for sure, I think an external review would be terrific. The danger always is it devolving into what I think tended to happen in 2025 and 2020, where the people who get, the outsiders who get picked really aren't fully outsiders and deliver the answer that's expected of them. But let me give a more hopeful answer, and one that dovetails with what Kate Judge said in her presentation. Historically, and this is a topic that Mike Bordo and Ned Prescott have written about in their scholarly research. Historically, the Fed Reserve banks have been outstanding sources of new ideas to improve the conduct of monetary policy and even to improve the conduct of bank regulation. I very much lament what I see as increased interference from the Fed Reserve Board in the presidential appointments process for the reserve banks, and perhaps the element of interference in the development of new ideas from the Fed Reserve. I think one of the Fed Reserve's great strengths has been its decentralized structure, decentralized geographically, but also decentralized intellectually, and restoring that intellectual diversity might accomplish exactly what you're hoping for.
If it's possible, I think that perhaps Peter's blistering criticism was not blistering enough in this respect. If you go and look at the Fed staff papers that were prepared for the most recent review, what you will find is that over and over again, those Fed staffers indicate that there's no consensus on whether the most recent inflation was primarily driven by supply or demand, which is kind of astounding. If you have supply-driven inflation, then the price level will rise above trend while supplies are constrained and return to trend as those constraints ease up. And that is not anything like what happened. If you have supply-driven inflation, you do not see a permanent rise in the path of nominal spending. When we look at the data, we see that prices are permanently elevated, nominal spending is permanently elevated. It is really, really hard to look at that data and say, this could have been all supply shocks. No, that doesn't work. And yet, time and again in those staff papers, you get what is essentially this may not have been our fault, right? We don't really know what caused this. The inflation came out of the ether, and fortunately we were there to bring that inflation back down. So I'm not convinced that an internal review is all that useful based on the internal reviews we've seen so far. So I think an external review is the next logical step.
Yeah, you're up now. I'm trying to get the next one lined up.
Just a quick comment on what Andy said, and then I have a question. I was invited by the Fed to the 2019 review session and their recent one last summer. And the original review in 2019 that culminated with their strategy, it was preordained. Every paper that was given, it was just preordained that what they were going to roll out, the FAIT, everything they were going to do was just set in cards. Okay, and I looked around the room, and I felt like kind of a loner in the room. There were about 10 of us sitting in the back, and the most recent one that the Fed was, you could just tell their body language was much more open. They weren't willing to admit that they made a mistake in 2020, 2021, 2022. But still, it was an orchestrated affair. So it wasn't really a review the way all of us in the room would think of it to be a review. My question about...
But before you ask your question, can I make a comment on this? In fact, that research conference occurred after the Fed had already decided, or at least judging by the minutes, what it was going to do. It had already met to discuss how it was going to deal with its employment mandate. It had already met to discuss how it was going to deal with its price stability mandate. And then it holds this conference that's supposed to inform those discussions. If you're interested in conducting a review, you got to have the conference before you have the discussion. So that it just doesn't make sense.
So here's my question. So last summer, the Fed establishes its new review, and as you have said, they move back toward a 2012 type symmetry. Yet, they lowered rates in September, October, and December, even though inflation was, well above their mandate. Please comment.
Well, there are two parts to the question. One is the strategic issue overall. The other is a specific issue about the wisdom of the last interest rate cuts. In terms of the strategic issue, as I mentioned in my comments, I am concerned by the fact that the return to the 2012 principles was partial and not complete, and that even running through the strategy statement itself, this is not hidden. It is in there. It's language that elevates unemployment above inflation. I think that is an approach to monetary policy making that's failed in the past and is going to fail in the future. Look, regarding the last 3 rate cuts, different people will differ. I agree that I would be uneasy with rate cuts when the measured rate of inflation remains well above the 2% target. The issue with there being lags in the effects of monetary policy is, are you confident enough that the underlying trend in inflation is still on a downward trajectory? Okay, and I guess what I would say there is, I'm just speaking, this is mere guesswork, but this is how the meeting-by-meeting approach goes. I'm not too worried about the 3 rate cuts. If you take a look, nobody looks at M2 growth but me anymore. Okay, but if you take a look at M2 growth right now, the annual rate of M2 growth is something like 5%. And if you measure it according to the Divisia measures that I prefer, it's actually closer to 4 than 5. Okay, in light of, again, strategically, I don't like to think of the Phillips curve as a way of making monetary policy, but in light of, okay, detectable downward trend in inflation, modest rates of money growth, and perceptions of a weakening labor market. Okay, if I'm on the committee and the decision is, hey, Peter, do you want to change the dual mandate? Okay, it's what do you do with the federal funds rate? I would have eased too.
I for one would vote for Peter on the FOMC. Just not that it's worth much, but I did want to spit in one more question here. There's discussion to be had amongst you folks. Can we get this gentleman over here? Can you?
Thanks. Noah Williams, University of Miami. So one, just a brief maybe addendum. I mean, I think you've kind of overplayed the death of the Phillips curve in the academic literature. Most of our models still, I mean, they make a distinction between a short run and a long run. So there's, I think there's very much the commitment and credibility type issues that there are always going to be a temptation to in the short run, treat expectations as fixed. We're not going to adjust them, and on a meeting-to-meeting basis, still face this trade-off. That's one thing. The other thing, kind of more broadly, in talking about the framework and the overview and going forward, another part of the framework change was kind of distributional issues and kind of a focus on, maybe running the labor market hotter. I think there's also a broader trend in the academic literature looking at distributional issues and heterogeneity. So I wonder, just nobody commented on kind of the inclusive growth aspect of it. I wonder how you view that.
Well, yeah, you're right. In that 2020 framework, this speaks to what Peter was talking about in his remarks. In that 2020 revision, they referred to the employment mandate as a the maximum employment mandate as a broad-based and inclusive goal. And it's very clear by looking at statements from Fed officials, which my colleague Brian showed earlier, that there was this push to perhaps run the economy hot to have these distributional effects. It's curious that they didn't think of the price stability side of the mandate as a broad-based and inclusive goal. Presumably that is also broad-based and inclusive. What's interesting with the most recent revisions is that some of these things have been removed, and we've even been talking about this as a return to the 2012 framework in many respects, but it's not really a return to the 2012 framework because they have been implicit in cases where an explicit statement is necessary given the recent changes. So for example, they're no longer committed to engaging in that makeup policy, that asymmetric makeup policy. But they also didn't reinsert the word symmetric, which they had since 2016. So have they removed the asymmetry? I don't know. They don't say whether it's symmetric or asymmetric. They've just left that open. Are they going to pursue this in a balanced way? Again, lots of questions where you could have made this very explicit, and one would expect that it should be explicit considering the ambiguity that's created given their prior revisions.
Great question. There's actually a great paper by Christina Romer who looked into whether the Fed ran the economy hot for those inclusive goals, and it showed that yes, this is the case, but there was another component that labor economists actually think that running the economy hot isn't actually beneficial in the long run for reaching those inclusive goals. And I heard one labor economist kind of sort of laughed dismissively that the central bankers think they can fix these challenges. So I thought that was rather interesting. There's great literature there to explore further.
I would just add very briefly, I would point out that Noah Williams actually is the leader in our profession in answering the question, exactly why is it that economists cling and policymakers cling to the view of an exploitable Phillips curve? It's a difficult thing to handle in the data, and his work has really helped us understand that.
Great. Well, please join me in thanking our panel from session 2. And we're going to do a quick switcheroo. So we have just a minute. Mic down. I'm going to invite session 3 to come on up. And we're going to talk about fiscal dominance.
And this one is the one that wasn't working.
It's working now. I hear you on here.
Thanks, Lydia.
Want to retake their seats? As we get started here, let me introduce you to session 3, where we're talking about fiscal dominance. We've been having a day of monetary policy, but it's nice to look at the other side. In economics, you're usually taught about the monetary, your central bank, and then you're like, wait, what about this congressional thing over here, or this fiscal side, this government side? And the question of fiscal dominance is one that is very real for today, about whether or not our government spending may force the hand of our monetary authority to help enable some of that spending, among a number of other questions and considerations related to the size of our fiscal balance sheet. So, but to get us started, we have our panelists here, and I'm going to take them in no particular order and then introduce them to come to the stage. But we have with us Michael Bordeaux, who also deserves a round of thanks for helping organize and support this conference. I think it may have actually been his idea to begin with. He is a member of the Shadow Open Market Committee, but he's also the Board of Governors Professor of Economics and Distinguished Professor Emeritus at Rutgers University, and he's Duncan Stewart Distinguished Visiting Fellow from the Hoover Institution as well. And he's had so many other visiting professorships, and his CV is too long to recount. And then we have next to him Mickey Levy, who's a visiting fellow with the Hoover Institution and also a member of the Shadow Open Market Committee. I always get the most insightful commentary from him at the end of conferences, including that Fed conference. I learned that there was a new approach that we could have been taking at that time. And then we have Josh Hendrickson, who is the chair and professor of economics at the University of Mississippi, and he's also a senior fellow with AIER's Sound Money Project, so I have the good pleasure of getting to work with him on a regular basis and have him contribute his excellent work to our portfolio. So without that, we're going to begin with Mickey Levy to give us a bit of an overview of fiscal dominance and what it means. Thanks, Mickey.
Pleasure to be here, and congratulations to FAU and AIER and the Shadow for putting this on. I've been a member of the Shadow Open Market Committee for a long time. It's a great organization. Anyway, the title of my talk is Fiscal Dominance and Policy Slippage. And so when we think about the monetary and fiscal authorities, the Fed is independent to achieve its dual mandate, which of price stability that it defines as 2% inflation and maximum employment, while the Congress and the executive branch manage fiscal policy, that is spending and taxing, to achieve desired outcomes in national security, infrastructure, health, income security, and more, without interference from the monetary policymakers. And so the issue of fiscal dominance has to do with concerns periods in which fiscal extremes, say high deficits, high debt or high debt service, impinge on or influence monetary policy. And such fiscal dominance typically results in bouts of higher inflation. So in 1981, in a path-breaking paper, Sergeant Wallace set up a game theoretic model that pitted monetary dominance versus fiscal dominance to determine policies and outcomes. And they showed that monetary authorities must dominate to achieve desired price stability, while fiscal dominance results in inflation in different ways. And they posed the following conflict, quote, which authority moves first? In other words, who imposes discipline on whom? And this is just modified by Eric Leeper in 1991, who characterized monetary and fiscal regimes as either active or passive in determining policies and outcomes. And so the historic experience of fiscal dominance in the U.S., the Fed has normally dominated They've typically dominated, but there have been bouts of inflation. And if we just consider financing of major wars, that's generated inflation. Sometimes the Fed a combination gives into political pressure. We've had many historical experiences with hyperinflation and numerous experiences with double-digit inflation. And then, of course, there's always the COVID inflation. It did involve a surge in deficit spending. So, the big question now is, are persistent deficits and rising debt pointing toward fiscal dominance? And the way I would summarize my position is, while persistent deficits are boosting debt and debt service costs, financial markets remain orderly as of now, and monetary policy dominates, but threats to the Fed independence do jeopardize monetary policy, and undisciplined fiscal policy definitely involves mounting risks. And so, let's face it, fiscal policy and the budget process operate without a strategy and without any systematic discipline. So will markets continue to readily absorb bond issuance? Will debt service costs become overwhelming? Will the lack of a fiscal strategy undercut the presumption or expectations of fiscal discipline? And, we've had presidents in the past put pressure on the Fed, and President Trump is upping the ante on that. And so I'd like to now focus on fiscal policy. And so I'm going to focus on fiscal policy in this monetary policy conference. Pre-World War II, fiscal policy makers' goals was actually balanced budgets. And then post-World War II, Keynesian policy activism, the goal of fiscal policy evolved toward balanced budgets over business cycles, deficits during recessions, surpluses during expansion periods, and the general kind of evolving acceptance of deficits. And then along comes the 1960s, where there was this dramatic shift in fiscal priorities. The establishment of Medicare, Medicaid, the enhancement of what was called food stamps, the Great Society programs, and the Vietnam War spending. And when we talk about the great inflation of the 1970s, it really began in 1965, the great inflation that ended in 1982. And so beyond what the Fed did, or associated with it, you had boosts to Social Security benefits, significant benefit increases, the first peacetime deficits, and the fiscal goals shifted toward lowering deficits, not price stability, but lowering deficits. And then first in 1972, you saw the first long-term budget projections that started to show real problems. Okay. On budgeting for entitlement programs, I want to underline or underscore that word, entitlement, because Social Security, Medicare, food stamps, net interest costs were considered under a term entitlement. And entitlement spending do not require annual legislation by Congress. They're automatic without budget authorization, whereas discretionary spending, defense, infrastructure, and the like, education, require annual authorization. And then little by little, entitlements became indexed for inflation. By the way, in 1981, under President Reagan, the individual income tax system was also indexed for inflation. And then along comes the 1990s, where the term entitlements kind of morphed into the term mandatory spending. And so in the 1990s, when there was this big effort to reduce deficits, the budget control legislation only addressed non-defense discretionary spending and not entitlements or mandatory programs. And note that in the late 1990s, there were some cash flow surpluses due to a sharp cut in defense spending post-Cold War and booming taxes, rising taxes from booming markets. But on an accrual basis, the debt continued to rise. Tax cuts in response to 9/11 and then the great financial crisis, government debt increased from 40 to 80%, and then, you know, COVID and the surge in deficit spending through, you know, legislation that involved huge outlays in spending, even when the economy was booming, and the federal debt to GDP rose to 100% of GDP, and now, I mean, I'd like to emphasize that just the compounding of inflation-indexed entitlements and enhanced benefits, plus the aging population, it just dominates the cash flow budget and deficit projections. And so it's just in the cards. So this is obvious. Fiscal policy lacks a strategy. We can have debate after debate and monetary policy conference after monetary policy conference, and we can quibble about what the Fed's trying to achieve, but at least it has a broad strategy that we could poke holes at. Fiscal policy, it's not guided by any strategy or any framework. The budget process is dysfunctional, and you can ask privately members of the budget committees in Congress, and they like it, the fact that it's dysfunctional, because then they don't have to make hard decisions. And there's no political appetite for cutting current or future spending by either political party. And you know, the perception that, you know, it's kind of the third cutting entitlements is like the third rail, you know, it just makes cuts in persistently high deficit almost untouchable. So fiscal policy's not really taken seriously. So, you know, look, I've been forced to run through this, but let me just conclude with this slide and say, will fiscal policy eventually dominate and lead the Fed to blink, or will the Fed be forced to blink? And this depends on whether fiscal policy dominates, depends on financial markets. Does the absorption of bonds trigger a spike in interest rates? I left out a phrase here. Or does it lead to a sharp decline in the actual or expected dollar? Or does it lead to a stock market collapse? And do these pressures lead the Fed to alter monetary policy? And we've heard earlier today about how we have had the Fed cave in to political demands. And in fact, if you go back to the mid-1960s when LBJ twisted the arm of Chair Martin not to raise rates, you could say that was a form of fiscal dominance because of the combined guns and butter budget. But you know, right now, President Trump is exerting pressure on the Fed. He's forcing Fed. I think he has plans to change membership of the Fed, and if that threatens the Fed's independence, and you know, the economy and financial markets, you know, we really benefit from an independent central bank, and you know, the current environment facing the Fed is very worrisome. And let me add another bullet that's not on here before the last one. A key concern is when we look at not just deficits per se and their persistence, but how we're deficit spending and the composition of the deficit spending not just threatens future inflation, financial markets, and the dollar, but it involves an allocation, I would say misallocation, of national resources that over time undercut long-run productive growth. And we're certainly not facing that at all. Having said all that, my concluding remarks is somehow I'm cautiously optimistic that eventually there will be, when push comes to shove, there will be an eventual deficit-cutting resolution, maybe on legislation that changes projected deficits by cutting, say, Social Security or the SNAP program or whatever, that eases the risks. Having said that, it's a real concern. It deserves a lot of attention, along with how the Fed interprets its dual mandate. Thank you.
Thank you, Mickey. I'd like to invite Mike to go up.
Okay, it's great being here, and you guys have done a fantastic job, better than I expected. I expected a lot, but this was great. I'm an economic historian, and I'm going to talk about, give you a cautionary tale of fiscal dominance that could be really something we should think about because it's an advanced country that we know. And so my paper is called The Perils of Fiscal Dominance, a Cautionary Tale for the U.S. from the Great Inflation in the UK from 1965 to mid-80s. So today, the U.S. has a high and rising fiscal deficit with no relief in sight. This is the primary deficit. Okay. The federal government's debt to GDP ratio is close to 100%, which is a level not seen since World War II. The U.S. is in peril of abandoning the fiscal orthodoxy that it adopted from the British 2 centuries ago, called the Treasury view. Okay, so the Treasury view. Fiscal orthodoxy was first developed in Britain in the early 18th century. It was called the Treasury view, comes from something that Ralph Hawtrey wrote in 1925, and this was followed for 2 centuries. Story is, you run fiscal deficits to finance a war, but you have to offset it by a surplus. And that in the long run, the present value of government expenditures must equal the present value of tax revenues. And in 1979, Barrow calls that tax smoothing. And that's at the heart of the modern theory of optimal fiscal policy with Lucas and Stokey and Cherry and others. So this picture, that's Walpole, the guy on the left. Okay, he's where it comes from, and Gladstone, who was this great advocate of the Treasury view in the 19th century. There are 2 big papers behind this that we put out as NBR working papers. Okay, this is the picture for the UK. This goes from 1700 to World War I, and you see these periods of debt. The debt's running up in wars, it runs down, it runs up. Okay, I could run it through the 20th century, but I think this gives the picture. So the great inflation in the UK, this is based on work I've done with Oliver Bush and Ryland Thomas at the Bank of England. It's a project we've been working on for a long time, and it's going to be a book. So that's a case study of what happens when the Treasury view is abandoned. And what we argue is that fiscal, more than monetary actions, are the key to understanding the great inflation in the UK from the 60s to the 80s, and that the Treasury view was abandoned by the Treasury's adoption of John Maynard Keynes' views. This is John Maynard Keynes with Morgenthau, okay? And so we argue that fiscal consolidation was necessary to securing low inflation, complemented by tight monetary policy, and that inflation expectations were kept under control through a sequence of fiscal regime changes. And we argue that in the case of the UK, different from the US, the US story normally is, Arthur Burns caused it and Volcker fixed it. So in the UK case, it's not the Bank of England, it's really a fiscal story. People could argue, and there is arguments, there are papers now that would move in the direction of the fiscal story for the US, Okay, but still the dominant story is it's money versus fiscal. So the UK Treasury was largely responsible for stabilization policies. And the Bank of England was not independent, and it was subservient. So the analysis we have is resonant to modern fiscal theories of Sargent and Wallace that Mickey mentioned, and Chris Sims and John Cochrane and Eric Leeper. So here's the picture. This is the UK in blue compared to all the others. It's the great inflation. So I'm not going through all of this, but we know the great inflation. But the UK is the blue one, and it was worse. So inflation peaked at 25%. I didn't include Italy. It was up there too. That's also a bad story. Okay. The UK experienced 4 prominent peaks of inflation. Okay, this is a picture that I'm going to talk about. I'll keep flipping back to it. Okay, so the first one, from 1960 to 1971, inflation rose from 2% to 10%. And what was going on was that they had followed this policy called Go Stop. We did something like that in the States. And the idea based on Keynesian ideas was you run hot fiscal policy and you stimulate the economy. And they thought, in the UK, they went a little farther than here. They followed theories of Kaldor and Harrod, that if you actually, use fiscal policy tax cuts to stimulate investment, that through the Harrod-Domar model, you get an increase in the growth rate too. So you get potential growth with rising. So that's the model they followed. So that's what they did. Okay, but the problem was, and so this is fiscal. The Bank of England's accommodating this. Okay, but the problem was this period up to 71, UK's under the Bretton Woods system, pegged exchange rates. It's not a small open economy, but it's pretty close to 1. So they run the economy hot. What happens? You get a balance of payments deficit. There's a crisis. The Fed, the IMF comes in, rescues them. They put pressure on them to reform. They don't, but they try to. So they go the other way and they tighten a little bit. And then the pressure comes to loosen. So you had 4 periods like this. Okay, each of them ended with a currency crisis. Okay. The second period, so the first period peaks in 1971. Second period peaks in 1975. What happens? Bretton Woods collapses. Okay, that removes the balance of payments constraint. Collapses because of stuff that we did in the U.S. It's not a UK story. They're part of it. The key shocks in this period are what's called the Barber boom. He's a Chancellor of Exchequer. He really buys this story of going for growth. And they run a very, very expansionary fiscal policy. Okay, and he wants to raise the growth rate to 10%. Okay, so what happens is inflation shoots up. Okay, same time, they liberalize the financial sector, competition and credit control. That increases the money multiplier, so you get this increase in inside money. Okay, then you've got the OPEC oil price shocks. They accommodated them with fiscal policy, with tax cuts. And then, and it's going to take the whole story, but I won't give it, they had these labor union problems. And so they had these public sector labor unions, okay, that would hold up the economy and go for large wage increases. And they got them, and how did they get them? They did it with tax cuts. Okay, they subsidized it with fiscal, they paid for the wage increases with fiscal policy. Then the other unions, the private sector would go on strike, wildcat strikes, to catch up. Okay, so and then you've got incomes policies, and they were very unsuccessful, just like in the US. And so you get the perfect storm of 25% inflation in 1975. Okay, the third episode, from 75 to 77, you got a currency crash because you're on a floating exchange rate, so you don't get a balance of payments crisis, but the currency drops. Okay, Reinhard and Rogoff called this the currency crash, and inflation shoots up, and then the IMF comes in, and they come in with the black cars in the middle of the night, and this is what they do in Argentina. So it's a big deal in the UK. They get very upset about that. That served as a signal for fiscal policy reform and also for putting moral suasion pressures on the unions. And so the last episode goes from 78 to 82. Then you get the second oil price, OPEC shock. That was accommodated again by fiscal policy. Then there are these strikes, and they have this winter of discontent. And if I had more time, I'd show you some great pictures of all the strikes and all the stuff that was going on. Then you've got what's called the medium-term strategy for broad monetary aggregate contraction. So they listen to the monetarists. They start cutting money growth, just like we did in the States. And then Thatcher comes in, and she breaks the power of the public sector unions. And that is when things really start to improve. So this just shows you, this picture, which I won't go through, shows you the public sector deficit and tax changes associated with demand management. So this story sort of goes through all of the different chancellors of the Exchequer and what they did. So a key takeaway from this brief narrative is that the interaction of fiscal, monetary, and financial had important implications for inflationary expectations, for asset prices, and wage determination. And it was fiscal policy that was the key instrument that we used to manage aggregate demand before 1976, when the Bank of England was not independent of the Treasury. It was fiscal policy as much monetary policy that appears important in both the run-up and the ending of the Great Inflation. And there were three major fiscal consolidations in 1976, 81, and 93, 94. And what happened is you had these large unexpected budget deficits, which came out of subsidizing the increases in energy prices. You had large public sector settlements, wage settlements, and government spending plans set in real terms. So it's a really, so there was, in a sense, money illusion there. And all of this is funded by the banking system, increasing broad money growth. And so the financial markets incorporated the unsustainable budget deficits and the faster money growth into their expectations, leading to the currency crash in 1976 and then the rescue by the IMF. And that is what led to the shift towards fiscal consolidations and reform, and eventually returned it to price stability. So in the paper, I mean, in our papers, we go through the theory of it. There's a lot of econometrics, there's a lot of stuff. But basically, we examine whether the recent theories of fiscal dominance have resonance for the Great Inflation. And we use a narrative evidence where we look at, in a sense, speeches by different chancellors of the Exchequer going through time. Okay, and we see that, in a sense, that the speeches fit very well into this sort of distinction between, like, dominant, active fiscal, passive money, or the other way around. You see how this changes over time. Okay, and so to give you an example of this, okay, here's a guy, Douglas Wass. He's permanent Secretary of the Treasury from 1974 to 1982. He says, whether the budget was in balance or had a surplus or a deficit was of virtually no importance. Okay, then we trace through, we show that all the guys who followed him for the next 5 or 10 years said exactly the same thing. But one reason why they did this is that they discovered North Sea oil in the 1960s, and they thought that this would be to get them out of this mess, that the revenues would somehow or other come forth to balance the budget. But then, of course, what happened is you had the crisis in 76, the IMF comes in, and then they begin to recognize the link between the fiscal deficits and broad money growth. And so what we do is we view the demise of the Treasury view and the active use of discretionary fiscal policy as evidence of fiscal dominance and the fiscal explanation of inflation. So I'm going to take 1 minute, sorry. Oh yeah, here's one more speech. So this is James Callahan. This is like after the IMF comes in. He says, we used to think that you could spend your way out of a recession and increase employment by cutting taxes and boosting government spending. I tell you in all candor, that option no longer exists. Here's what Milton Friedman said, okay, in Newsweek. This was one of the most important speeches ever made by any government minister on economic policy. Okay, so, and then you have these fiscal consolidations, okay, which leads to eventually They go back to the Treasury view in the mid-'80s with Chancellor Gordon Brown. The Treasury, the Fed, the Bank of England, gets operational independence. Okay, they go to an inflation target. So that's how the story ends by the end of the 1980s. Okay, so this is just showing the fiscal consolidations and the inflation. So the lessons from this for the U.S. are, obviously things could get that bad. Okay, and it is consistent with both stepping on the rake story of Chris Sims or the Sargent and Wallace story that Mickey talked about. Okay, but in a sense, the question is it going to happen here? And I also talk about Latin America, but I don't have enough time. But basically, I agree with Mickey that, in a sense, I don't think this is going to happen, okay, in the U.S. in the near future. But if we don't address the fiscal imbalances, then this is something to think about. These dire outcomes could happen even here. Okay, so thank you.
Thank you, Mike. We'll now invite Josh to come up to the stage. Thank you, Josh.
Thanks for inviting me to talk about this. If you were looking for more pessimism, I think that you found the right place. Essentially, kind of what I want to refocus kind of the discussion of fiscal dominance on sort of a characteristic of the monetary system that we have globally. Okay, so I think that this is actually really important for thinking about our debt trajectory. I think it's really important for thinking about the extent to which the Federal Reserve can even stop an inflation that sort of originates with fiscal policy. And so I kind of want to frame this. I stole this term from somebody. I don't remember who it was, so if you're in the room, I apologize. If not, I made up this term. This is my coinage. You can use it freely. So I sort of label this the Treasury standard, and so what I mean is that it's sort of meant to be analogous to the gold standard, and I guess what I'm trying to get at is that if you look at the international monetary system, the US dollar is the global reserve currency, and the US Treasury is the global reserve asset. And so the United States is in this really unique position, and it's in this unique position because it's essentially serving as an intermediary to the rest of the world, right? So the United States has claims to all these risky assets on the rest of the world, and it's issuing these supposedly safe liabilities to the rest of the world, right? So it's a lot like an intermediary, but if it's a lot like an intermediary, then we have to really think about, what are the potential consequences of that. And so, first of all, I'm going to get to the costs, but before we get to the costs, we might want to think about the benefits of this system, because if I start talking about the costs, you might think to yourself, okay, well, there's a lot of costs, why don't we get rid of it? Well, the benefits of the system here is that, the United States has this exorbitant privilege, right? So the United States government is able to borrow at lower rates than it would otherwise be able to because of the way the international system operates. One thing that's been pointed out is that as an intermediary to the rest of the world, it looks like a bank. The U.S. holds a lot of claims to risky assets, and it's issuing these safe assets with lower rates of return, and so effectively, you're generating this profit like a bank would have. The other thing is that because of the dollar's role and because of these Treasury securities' role, the dollar is essentially stronger than it would be in a counterfactual world where we had some kind of alternative system. And so what that means is that that makes foreign goods cheaper than they otherwise would be. It also makes foreign inputs cheaper, which is a separate issue. But most importantly, what it allows the United States to do is it allows the United States to engage in emergency finance. The United States can raise large amounts of money in very, very short periods of time without really affecting markets all that much, right? So their borrowing costs don't change all that much, even when they have these very, very large even when we experience very large sort of government spending in an emergency. So you think about COVID, or you think about a war or something like that. The United States can generate a lot of, the United States government can generate a lot of money in a very short period of time without affecting markets very much. But then most importantly, because the US Treasury is a global reserve asset, what this does is it sort of relaxes the government's budget constraint a little bit. And it relaxes the government's budget constraint because you've got all of these, you've got all of this passive demand out there for US Treasury securities, right? And so because of that passive demand, by passive demand, I mean that these are buyers that are not particularly price sensitive to what they're buying. And so you're not getting the same sort of discipline that you would get in a typical system, because you don't see, when you have rates, you don't see interest rates rising very quickly when you run large deficits or things like that. You don't have that sort of those market prices signaling to you that you're borrowing too much. So those are the benefits. What are the costs? So I think a really good framing of this is there's a great paper on the international monetary system by Fari and Maggiore, and essentially what they argue is okay, if we think about the United States as kind of this intermediary to the rest of the world, then what we can kind of think of is that the rest of the world is buying this asset because what the United States is able to do that other places aren't able to do is they're able to supply this safe asset to the rest of the world. People are looking for a safe, stable store of value. They find that in things like T-bills. And so the primary risk to the people who are buying those things is just whether or not they're going to get their real return back or not, right? So they know that the United States government is not going to default on the debt in a traditional sense, but what their risk is that they're effectively afraid that at some point maybe the United States might inflate away the value of some of that debt. Okay, and so what they point out is that there's sort of like a nonlinearity in the system. There's a nonlinearity in the system because what's happening is that as the rest of the world demands this debt, their expectations that they're going to get paid back in real terms is sort of a function of how much debt there is in the first place. So very low levels of debt, nobody's worried that that the United States is going to inflate away the value of its debt, and so there's very little risk. People don't expect that. It's not a big deal. But what they point out is that there's a threshold for your debt, and there's a threshold for your debt where when you hit that threshold, there becomes some positive probability that you there becomes some positive probability that people expect the United States to inflate away at least some of its debt. And so when you get to that point, the question is, how do people respond to that? And so their point is that when you get your debt into that range, there's effectively a positive probability that the system starts to unwind. And so what I mean by that is that if people become convinced that the United States' debt trajectory is unsustainable, and they decide, hey, I think they're going to inflate away all of this debt, it can create this sort of self-fulfilling prophecy, right? So people start dumping treasuries on the open market, the treasury market becomes pretty volatile, and then the Federal Reserve kind of acts as the buyer of last resort, right? So what we would expect to see in this sort of situation is like the we would expect to see treasury markets with a lot of volatility. We would see like some odd pricing in compared to what we normally see. And so what would happen is the Fed would kind of step in and say, hey, we're seeing these disruptions in the treasury market, and so we're going to step in and we're going to kind of stabilize the market. And in effect, what that would do is that would just build up the Fed's balance sheet over time, and it would actually lead to the very inflation that people are afraid of in the first place. And the important thing that I think to stress about this is that we should worry about nonlinearities, right? So the prediction of this model is there's this sort of nonlinear world where you can be going along every day and everything seems fine, and then all of a sudden you wake up the next day and everything is different, right? And so it's not as though you get these warning signs that something bad is going to happen. One of the things that they kind of point out is that it would tend to happen sort of all at once. And so it's not like you're going to see this gradual increase in interest rates and then you get some sort of fiscal inflationary crisis because they ignored the warning signs. It's that, by the time you see the warning signs, it's too late. So what can be done about this? Well, it's a difficult thing because even engaging in fiscal responsibility here creates some issues, right? And the reason I say that is that we've kind of flip-flopped between these kinds of regimes since the financial crisis, where when you've got this excess demand for safe assets, and in particular these US Treasury securities, what it tends to do is it tends to push yields down, right? And so we tend to get these artificially low yields, which sort of distorts capital allocation and things like that. And but at the same time, the alternative is well, if there's an excess demand for the debt and we can borrow at really cheap rates, well, let's just borrow a lot more. So let's meet that excess demand by just supplying the debt. And the problem is that when you start to look at that, if the rest of the world is kind of growing faster than the United States, that just meeting the demand for those treasuries is going to put the debt on an unsustainable trajectory, right? So if you're trying to meet this demand and the rest of the world is growing faster than you, then that debt trajectory, kind of eventually starts to work against you. And so when we think about this, I mean, that's one of the things about, the period after the financial crisis is there were a lot of people talking about how interest rates were very, very low. And I don't know if we're allowed to mention Larry Summers anymore, but Larry Summers has this paper where he basically said, look, real interest rates would have been even lower, if not for sort of the fiscal policy of the United States. And that's sort of consistent with this idea. The other thing is that if we were to try to do some kind of reform, or if we were going to try to replace this system in some way, the difficulty is that my own work, kind of suggests that the Treasury standard is kind of part of this evolution of the financial system, and so it's not, and the monetary system, and so it's not just, we didn't end up here by accident, right? The way that I describe this is like this system was created on purpose, but not by design. Nobody came up with this system and said, this is what we want to implement, but they were moving towards a system like this on purpose, right? Policymakers from Nixon to Ford to Carter and even into the Reagan administration were very, very adamant about dollar dominance and creating and enhancing this kind of system. And so, so the difficulty here, right, is that we've got this unsustainable debt trajectory. That unsustainable debt trajectory seems very much tied to our international monetary system. There's reason to believe that we should be concerned about sort of nonlinearities in that international monetary system, that you wake up one morning and everything is different. And so, when we're sort of thinking about this issue, it's not really clear what the path forward is, because it's not clear to me that the Federal Reserve can stop these sorts of things. I think the Federal Reserve is always going to be the buyer of last resort for US government debt. And so if our fiscal trajectory doesn't get in order, we're probably, we're probably going to get inflation regardless of whether the Fed wants to accommodate it or not. At the same time, just imposing more fiscal discipline isn't going to change the international monetary system, and so yes, it will make the debt more sustainable, but you have these other economic frictions that pop up because of the sort of distortion in relative prices in financial markets because of this excess demand for US government debt. And so the question is, where do we go from here? Like, are we just on this inevitable path towards fiscal dominance where we're just going to end up with inflation whether we like it or not? Do we need some kind of reform of the international monetary system? The United States is very, very hesitant to do things like that, and for good reason, right? The United States looks at it as like we have all of these benefits, and if we sort of allow things to diversify, then what we're doing is like potentially transferring some of those benefits from us to someone else, and someone else might be one of our adversaries. And so I'm afraid that I'm even more pessimistic than the others in the sense that it's not clear what the path out of this is, but it's also not clear that the Fed can necessarily save us.
Thank you, Josh. On that very optimistic note, let's talk about some of those issues a little bit more. So what, if anything, can a monetary authority even do in the face of fiscal dominance, in the face of extra government spending at levels that sort of push towards this inflationary trajectory? Must the central bank support those fiscal deficits, or could they do something to try to constrain this challenge that we're in, or are they always that borrower of last resort enabling this type of challenge?
The best thing that the Fed should do is pursue its mandate of low inflation, and not respond to fiscal. I mean, when you have a fiscal authority, if you have a monetary authority that does respond to fiscal authorities, then you really run into trouble.
We just had the Fed increase QE recently. Does that say that we're on the right trajectory for not increasing inflation?
They would say, the Fed would say it's a technical move. No, but I think this is exceedingly important. You have to distinguish between the roles monetary and fiscal policy play. And the monetary authorities, the Fed can keep inflation low. And as I pointed out, fiscal policy is not just deficits, but it's how we allocate and reallocate national resources. You've got to distinguish between the two.
Wait a minute. The definition of fiscal dominance, that definition means that they really can't do very much. I mean, the Bank of...
Closer, just closer.
The Bank of England's, the Bank of England, they had pretty competent people then, but they just went along with what the Treasury wanted because they were part of the Treasury. So that's what fiscal dominance means. So sure, in the case of the U.S., where the Fed is independent, in quotation marks, then the best thing is to just stick to their knitting and not do anything other than what they would have done to follow their mandate. But in a case where there really is fiscal dominance, there's nothing that can be done except what the Fed did in the late 1940s and 50, which is in a sense revolt against the Treasury, and that's why we got the Accord. Okay, but it took like a revolution.
The Accord being when the Treasury basically got to decide if the interest rate was what they wanted it to be. Turning back to some of what Josh was saying related to the bond markets, what is this going to mean? We have these deficits projected out into many, many years. They're at very high levels. We have a very high overall debt level. Do we expect bond markets to continue to want to support that level of debt to hopefully maybe prevent the Fed stepping in to support that level of debt and lead to more inflation? Or at what point do bond investors, whether international or U.S. domestic-based investors, when do they say this is too much debt for us to consume?
I think we're already partway here, right? Look at the Fed's balance sheet. The Fed's balance sheet expanded pretty dramatically during the financial crisis, and they kept promising, this is temporary, we'll go back eventually. Almost every time they try to go back, they run into problems in the Treasury market, and then they stop. And so I think that we're kind of already seeing some of these pressures here by the fact that the central bank balance sheet is already substantially larger than it was, and they don't seem to really have the ability to reduce the size of their balance sheet because every time that they make a meaningful effort at that, the Treasury market freaks out, and then they kind of step back in and they say they have to stabilize things, which prevents them from reducing the size of their balance sheet.
I'll take a different view on that. I think if
Oh, hold the mic closer.
I'll take a different view. I think if we were already, if it were already unfolding, then you would have bond yields going way up. So one of the critical points I would make is not just bond yields, but also the dollar, and not just the current level of the dollar, but the expectations about it, because a little over 30% of all U.S. publicly held debt is held by foreigners. And so their expected rate of return depends on the dollar and the credibility of the whole system. So what would really concern me is if for any reason we had a terrible quarterly auction and bond yields spiked and the dollar started heading south. So there's no question, but that could unfold. Am I concerned? Yes, but I don't see that we're in that danger zone yet.
I guess let me rephrase. So I don't think that we are in the fiscally dominant world yet. What I guess I'm trying to say is that in part what I see the Fed doing, so when it tries to shrink its balance sheet, for example, a lot of what they're effectively doing is that yields would be much higher if they didn't intervene. Now we can debate what is much higher, but I think that they would be higher. I mean, I think that's why they continue to step in, is that there's an upward bias in those yields in addition to more volatility in those markets, and so I think that they're stepping in to quote unquote stabilize them. But I think part of what's being stabilized is they're serving as the buyer of last resort, and so I don't think we're in a world where we need to panic yet. But I do think that maybe that's a sort of canary in the coal mine, that hey, the Fed does have to play this role, and that's one reason why I think the bond market isn't always going to give us an excellent signal, because if you have the Fed as the buyer of last resort, those price signals don't always get communicated.
I would note.
Let's let Mike chime in real quick.
Let me take one. If you take an ex-ante real rate on a 10-year bond, it's about 1 3/4. So you have a 1 1/4 inflationary expectations are about 2 1/4, and you have a bond yield at 4 point, so about a 2% ex-ante real rate, which is fairly consistent with history. Now look, you and I agree. I look at the budget and the total dysfunctionality of the budget process, and I'm extremely disappointed. And as I mentioned, one of the things we really need to focus more on is what that implies for the allocation of national resources and potential growth. But in terms of outright fiscal dominance, I really don't see signs of it. If the dollar really started to head south, then fasten your seatbelt.
Mike, what are your viewpoints here?
I mean, economic theory tells us
Hold the mic closer.
tells us that what matters is what the relationship between the real interest rate and the growth rate. So if we have AI pushing up the growth rate, and it's above the real interest rate, so your debt is sustainable, and that's why I think bond markets know that. They understand that, if the U.S. was in an emerging country in very bad economic shape and it had the fiscal problems, that'd be different.
Fair point. Related to some of these spending questions, though, about whether entitlements or mandatory spending, and even the example in Great Britain of the programs that were there, is this trajectory of governments on a spending path, is that a product of, would you describe that as a product of just some specific spending programs that are in place, or is there a more fundamental challenge that sets a nation up onto a fiscal dominance path based on their constitution or lack of some type of constraint, whether that's a balanced budget amendment or some other type of thing that would constrain, in our instance, Congress's spending?
Nikki, I'll tell you about the entitlements.
Well, I think there's two things. So one, if you look at the entire Western world, prior to, World War I mean, virtually all government spending was national defense and things like that. Post-World War II, the governments of the Western world look much more like insurance companies than they do like governments of the past, right? In the sense that they're now collecting tax revenues that are going to pay out benefits. And so I don't. So that's part of it. Is part of the question is like, you know, there is some sort of limit to like how generous like these programs can be, and that you can behave like that. And then the other thing is that, you know, we just experienced a period of like 10 years where you listen to politicians saying interest rates are near zero, like we should just be borrowing and doing every pet project that I can imagine because they're so, you know, because interest rates are so low, we should capitalize on those. And so I think that, you know, part of it is they're following the incentives, but part of it is there was this dramatic shift in the Western world towards what governments do in the first place.
Did you have a comment, Mike? I saw you.
I'll let Mickey talk about the entitlements.
Well, look, as I mentioned, you know, they're called entitlements because they do not require legislation every year to be renewed. They automatically are renewed. Social Security, Medicare, Medicaid, the SNAP program, and the list goes on. And some of them, like the government pension, Social Security, those are automatically indexed. Anybody venture a guess how many people receive the SNAP program, food stamps? Any guesses?
43 million?
Good guess. 43 million. If you're getting it, you're given a debit card, and it is automatically filled every month, and it is automatically indexed to the food component of the CPI. Okay, so you have these, and you know, these programs are the revealed preference of Congress. And there's no impetus or penalty for them to pass legislation. It's the third rail. I think eventually you're going to see a change. But as you and I mentioned earlier, it has a lot to do not just with fiscal dominance, but how we're allocating our national resources. And if we allocated them differently, we would have more to spend on infrastructure and everything else that provides a higher rate of return and would lift potential growth. So it's an allocation issue as well as a fiscal dominance issue. And our financial markets tend to be extraordinarily efficient, but they're also international. And that's why I toss in this point about the dollar and the global expectation about where the dollar is going to go affects expected rates of return on dollar-denominated assets. And this is...
Yep, the dollar's world reserve currency status has given us a lot of benefit as a nation and the programs we're able to support. I want to now turn it over to a couple audience questions if we have a couple. I will call on you, but let me check and make sure there isn't one other one. Well, you've both gone first, but let's switch the order. Let's start with you this time, and then we'll go to Andy.
So there have been kind of warnings of fiscal dominance, but as I'm sure Mike and Mickey have heard from their colleague John Cochran, and I hear from my own colleague David Andolfado, I mean, what's wrong with their interpretation of what we saw during the COVID period was a large and permanent increase in the debt, which was essentially monetized. So is that, like, what's wrong with that interpretation? Why don't you see that we've already experienced an episode of fiscal dominance?
There's nothing wrong with it. I think I think Cochran was probably right about that.
Yeah, meaning we had a huge increase in deficit spending, and the facts show that the Fed purchased about half of the increase in the bond issuance. And so it does fit Cochran's fiscal theory of the price level. My feeling is the Fed's keeping rates at zero and asset purchases were decided independently of the fiscal authority's decision. But nevertheless, ex post, it reads like debt monetization.
I think I saw a question over here, so Andy might have to wait. And I think there was another one way in the back, so if one mic can go here. And was there one in the back I missed? Raise your hand really high because I can't see past the very... Go ahead.
This is a question for the panel, but specifically to one of Josh's comments. You talked about the U.S. Treasury being the global reserve asset. To what extent do you think the damage was done when we seized Russian Treasury holdings after the start of the Ukrainian war and the response by other countries rebalancing their sovereign balance sheets away from U.S. Treasuries?
Yeah, I think this is a huge risk because one of the things that you've seen, and it's kind of been across administrations, I think it started in the second term of the Obama administration and has kind of continued, is the United States realized that it could use its financial position as a tool of foreign policy, not just monetary policy. And I think one of the dangerous aspects to that is that when you're in this system and you've got this built-in passive demand for your debt and you don't take that into account, the problem is if you start weaponizing that system, people start looking for alternatives, right? And so sort of the benefit to the United States right now is like there's really no great alternative. But the more that you give people an incentive to find an alternative, the more likely somebody is to find one or create one. And so I do think that that's another issue, is that you potentially have this tool, but you have to be extremely careful about how you use it, right? If you start using it as your primary tool of foreign policy, then this is going to have very negative consequences.
I think, Kate, did you have one quick question right here?
This is primarily for Michael and Mickey. You both provided such powerful narratives, and then you end on these optimistic notes. And maybe, Michael, you just answered it with your hopeful note about economic growth. But I'm really interested in why you are both. I was wondering if you could say more about the cause for your optimism.
Mike?
I look at what happened in the 90s. Okay, and I mean, when Clinton was in, they actually did fix it for a while. So I think that when the pressures get big enough, that the getting back to some of the stuff you talked about this morning, is the U.S. Constitution and the whole polity is basically mean reverting. Okay, and that there were forces that will come into play that will deal with this problem. Okay, and it may take it'll probably take the next administration to do this, being optimistic, but that's how I see it, and I'm optimistic about it. And I'm a Canadian, so I see it from outside.
Disinterested observer.
So Kate, I just believe very strongly in the resourcefulness and resilience of the private sector and the innovations and how they're implemented into commerce. And I just see the flow of them continuing, if not accelerating. At the same time, I'm very disturbed about not just deficit spending per se, but the fiscal process. And I, in all the times I've testified in front of the budget committees and financial services committees, I walk away and I say, that was fun and it was very honorable, but boy, oh boy, we've got problems. I really do, and we do have problems. But I think of the recent discussion about, the Social Security Trust Fund's going to run out of money, so people are going to stop getting their payments. Zero probability of that happening. Congress will, it's just, it all goes into a general fund, and they can just turn it on. Having said that, I do think, and we have had times in the past where when push comes to shove, Congress will respond. And there are pretty easy ways to cut projected deficits by quite a bit. They're going to be painful for some. I think if Congress really put together a responsible piece that cut projected deficits in half, I think the electorate would be very happy.
Well, on that very optimistic note, please join me in thanking our panelists. We now have a short 10-minute break before we have the honor of having the president of FAU come. Oh, wait. Before you go, we're going to take a group photo. Everyone look towards the windows. or that gentleman in the corner, actually. Everyone just look.
to reimagine what higher education could be. Today, Florida Atlantic continues to push boundaries and break down barriers as one of the top-ranked public universities in the nation. A leader in academics and affordability, Florida Atlantic drives social mobility for high achievers determined to succeed. And as one of only 21 universities in the country recognized as both a Carnegie R1 institution and a Carnegie Opportunity University, Florida Atlantic is where access meets excellence. This is more than a community of students and researchers. It is a growing network of thinkers and doers, of explorers and game changers who are solving today's challenges and shaping the future. Drawing strength from the region it leads and from the state it serves, Florida Atlantic leverages the uniqueness of South Florida's industries and environment to make waves locally and globally. From modernizing healthcare and harnessing ocean energy, to unlocking the mysteries of the human brain and building the structures of tomorrow, Florida Atlantic is at the cutting edge of innovation and winning at the highest echelon of intercollegiate athletics. An economic engine where the Everglades meets the ocean, bridging the gap between academic and real-world solutions, preparing the next generation of leaders in the industries that matter most, and raising the bar for what is possible in paradise. This is where tomorrow begins. This is Florida Atlantic University.
All right. Well, good afternoon, everybody. I am Adam Hasner. I'm honored to be the 8th president of Florida Atlantic University, and it is also a great honor to be with you here this afternoon. And I want to welcome you all. And for those of you who are not as familiar with Florida Atlantic, I want to welcome you to paradise. And so we're excited to have this event here today. I want to recognize some of our trustees, members of our board of trustees who are here, John Harrison, Tom Mersch, and Scott McClenigan. I also want to thank our College of Business Dean, Dan Gropper, as well as some of the top faculty members from our College of Business, and most specifically, Dr. Will Luther. Thank you. And then more importantly, I want to thank and welcome all of our students who are here joining this conference and this speech. And we played, so let's hear it for our students who are here. We agreed on playing the video in lieu of a long introduction of me and in lieu of me spending about the next hour or so telling you all of the exciting things that are happening at Florida Atlantic. There will be plenty of other times for that, but we have a very special guest to welcome here today, and I know you are all looking forward to hearing from him. And so we're excited to begin this new year by hosting today's event and being the place for conversations that will shape the future. We are a university on the rise, and we are proud to join the American Institute for Economic Research and the Shadow Open Market Committee, and welcoming all of the outstanding speakers who have been a part of today's conference. And so with that, it is my pleasure to introduce our keynote speaker today, Philip Jefferson, Vice Chair of the Board of Governors of the Federal Reserve. Vice Chair Jefferson is a distinguished economist and academic leader who has spent decades in higher education and public service. Before joining the Board of Governors, he served as Vice President for Academic Affairs and Dean of Faculty at Davidson College. He also previously chaired the Department of Economics at Swarthmore College. Earlier in his career, Vice Chair Jefferson served as an economist at the Federal Reserve and was president of the National Economic Association. Additionally, he served on the Vassar College Board of Trustees and the Board of Advisors of the Opportunity and Inclusive Growth Institute at the Federal Reserve Bank of Minneapolis. We thank him for joining us today and for sharing his expertise on this important and interesting topic. Ladies and gentlemen, please join me in welcoming Vice Chair Philip Jefferson.
Well, thank you, President Hassner, for that kind introduction. It is an honor to speak at Florida Atlantic University, and I'm glad to have a chance to talk to those here from the American Institute of Economic Research and the Shadow Open Market Committee. I also appreciate the opportunity to discuss my economic outlook at the start of a new year. It is a task made considerably easier with the gradual return of federal government data, which was disrupted by last year's lapse in funding. The lack of data reinforced two long-held beliefs for me. One, how grateful I am for the dedicated service of the statistical agencies to keep policymakers, businesses, and the public informed about the state of the economy. And two, how important it is to have access to an array of data beyond what those agencies provide. That includes data produced by the Federal Reserve System, state governments, and a wide variety of private sector sources. All of those data sources inform my view of the economy and help me to make better monetary policy decisions. Today, I will start by sharing my outlook for the economy at the start of 2026. Next, I will discuss the implications of that outlook for the path of monetary policy. And finally, I will discuss some recent developments in monetary policy implementation, which I know is of interest to many of you in this room. As a reminder, these views are my own and are not necessarily those of my colleagues. I am starting 2026 with a cautiously optimistic point of view. Conditions in the labor market appear to be stabilizing, and I see the economy as well positioned to continue to grow while inflation returns to a pathway towards our 2% objective. The most recent data indicate that economic activity has remained strong. The third quarter of 2025, gross domestic product rose at an annual rate of 4.3%. As you can see in Figure 1, that was a sharp acceleration from the first half of last year, mostly reflecting strong consumer spending and an upward swing in net exports, which can be volatile. Business fixed investment grew at a solid rate in the third quarter, while residential investment continued to be soft. Fourth quarter growth is likely to be restrained due to the effects of the government shutdown. Still, excluding those effects, I see the economy expanding at a solid pace of about 2% in the near term. Looking at the labor market, job growth moderated last year, and the unemployment rate edged higher. In November and December, employers added about 50,000 jobs to payrolls each month, as you can see in Figure 2. This came after payrolls declined in October, largely due to an unusually large number of separations from the federal government. However, even setting aside October, the broader trend last year showed slower job creation than in 2024. At least part of the slowdown in the job market reflects a decline in the growth of the labor force due to lower immigration and labor force participation. However, labor demand has softened as well. Meanwhile, the unemployment rate, shown in Figure 3, ended the year at 4.4%, up modestly from 4.1% at the end of the previous year. That said, the labor market is not deteriorating rapidly. as layoffs remain low. However, hiring remains low as well. Figure 4 shows that there were 0.09 jobs available in November for every unemployed American seeking work. While that level is normally consistent with a solid labor market, the ratio is considerably lower than a few years ago when labor market conditions were much tighter earlier in the pandemic. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. My baseline, however, is for the unemployment rate to hold steady throughout this year. Considering the other part of our dual mandate, inflation remains somewhat elevated from our 2% goal. As you know, the Federal Open Market Committee targets the rate of increase in the Personal Consumption Expenditure Price Index. However, due to the government shutdown, the most recent available PCE price data are for September of 2025. For this reason, I find it informative to review consumer price index data to get a timelier sense of the direction of inflation, even if it does not directly translate to our inflation target. Over the longer run, both CPI and PCE measures tell a similar story. Data released earlier this week showed that the CPI rose 2.7% over the 12 months ending in December, the same rate as November. Core PCI, which excludes food and energy prices, rose 2.6%, also matching November's reading. You can see in Figure 5 that both headline and core measures of inflation have eased significantly from their highs in mid-2022. However, that progress slowed over the past year or so, and inflation remains at a level that is above readings consistent with our inflation target. Looking at the subcomponents of core CPI, shown in Figure 6, we can see why there has been a slowdown in the pace of disinflation. Over the past year, we have seen further notable declines in services inflation, rent of shelter, as well as other non-energy services. But these declines have been offset by an increase in core goods price inflation. Looking at the three buckets separately, shelter inflation, shown by the black dotted line, has continued to decline. And core services inflation, excluding shelter, the red dashed line, has also been on a downward trend, albeit on a somewhat bumpier path. Those readings are consistent with overall inflation moving back towards target. What is inconsistent with a return to 2% inflation is the rise in core goods prices. Following very high readings during the pandemic, goods inflation fell sharply, reaching its pre-pandemic range in 2023 and fluctuated roughly in that range until 2025. Last year, core goods price inflation picked up markedly to 1.4% over the 12 months ending in December 2025, at least in part reflecting increased tariffs filtering through to certain goods prices. While some upside risk remain, moving forward, I expect to see inflation return to a sustainable path back to our 2% target. It is a reasonable base case that these effects of tariffs on inflation will not be long-lasting, effectively a one-time shift in the price level. My view that inflation will resume a path towards our goal is consistent with near-term measures of inflation expectations declining from their peaks last year, as reflected in both market and survey-based measures. And most measures of longer-term expectations remain consistent with our 2% inflation goal. Although I am cautiously optimistic about the path ahead, as a monetary policymaker, I do confront a challenging situation. With the downside risk to employment having risen last year, I view the balance of risk as having shifted. As a result, I supported the FOMC's decisions to reduce the policy rate last year. I viewed that as the right step to balance the upside risk of persistent above-target inflation and the downside risk of a deteriorating labor market. This policy stance puts the economy in a good position moving forward. As shown in Figure 7, since the middle of 2024, the committee has reduced the policy rate by 1.75 percentage points. In my view, those moves have brought the federal funds rate into a range consistent with the neutral rate, a rate that neither stimulates or restricts economic activity. I look forward to our upcoming policymaking meeting, which will be held in less than 2 weeks. While I do not want to prejudge the decision that will take place there, in my view, the current policy stance leaves us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Now let me turn to monetary policy implementation. I'll begin with a bit of history to provide a backdrop for recent developments. In January 2019, following many years of successful implementation, along with extensive deliberation, the Federal Open Market Committee formally adopted its ample reserves implementation framework. Some key advantages of this framework include successful control of the policy rate in a variety of conditions and effective transmission to other money market rates and broader financial conditions. The FOMC defined this framework as one where, and I'm quoting, control over the level of the federal funds rate and other short-term interest rates is exercised primarily through the setting of the Federal Reserve's administered rates and in which active management of the supply of reserves is not required, close quote. Therefore, the supply of reserves needs to be sufficiently large to meet the demand for reserves on most days. Against this backdrop, I'll now discuss recent developments in monetary policy implementation. As of December 2025, the FOMC concluded the process of reducing the size of the Fed's balance sheet that began in mid-2022 by halting the reduction of the Fed's asset holdings. During this process, we successfully reduced our security holdings by $2.2 trillion. This asset runoff affected not only our assets, but also our liabilities, such as the reserves in the banking system and the level of overnight reverse repurchase agreement operation balances. At the beginning of the balance sheet runoff in 2022, reserves were at an abundant level at about $3.5 trillion. As the balance sheet shrank over the next few years, the federal funds rate remained about 7 basis points below the interest rate on reserve balances, the interest rate on reserve balances rate for most of this period. The decline in reserves from an abundant level to an ample level exerted upward pressure on money market rates in recent months. As the level of reserves declined, repo rates started to increase and become more volatile. We began to see intensified rate pressures, especially on tax payment days and Treasury securities settlement days, when a large flow into the Treasury General account, another liability of the Fed, led to a corresponding decline in the amount of reserves in the banking system. The federal funds rate started to move up steadily in its target range, and it now stands 1 basis point below the interest rate on reserve balances. These and other indicators of tightening money market conditions were what we expected to see as reserves declined towards the range of ample reserves. It is important to note that while ending the asset runoff slows down the decline in reserves, it does not completely halt this process. Even when the Fed's assets remain constant, trend growth in non-reserve liabilities, particularly currency in circulation, will continue to absorb reserves over time. There is also significant cyclical variation in the supply of reserve balances, reflecting seasonal changes in the Treasury General account and other factors. Furthermore, the demand for reserves is not static, but rather dynamic, influenced by various factors, including economic growth and changes in the financial system. Consequently, to maintain an ample reserves level, a key operational objective of our current monetary policy implementation framework, the FOMC must expand its balance sheet commensurately with the public's demand for its liabilities. This necessitates a nuanced and forward-looking approach to balance sheet management that considers both cyclical and structural factors affecting the demand for and supply of reserves. With the level of bank reserves judged to have declined to an ample level, the FOMC initiated reserve management purchases in December of 2025. This was the crucial next step in balance sheet management to maintain ample reserves and ensure effective interest rate control, as consistent with the plan we adopted in May of 2022. It is important to note that these reserve management purchases are not quantitative easing. Each process has a distinct purpose with different goals and different economic implications. Quantitative easing represents a monetary policy tool deployed when the federal funds rate is constrained by the effective lower bound. The primary objective of quantitative easing is to provide economic stimulus by exerting downward pressure on long-term interest rates. This has been achieved typically through large-scale purchases of longer-term Treasury securities and agency mortgage-backed securities. These purchases are intended to influence the yield curve and broader financial conditions by removing duration risk held by the public for a given setting of short-term interest rate policy. In contrast, reserve management purchases involve the acquisition of Treasury bills and other short-term Treasury securities in a manner that further normalizes the average maturity of the Federal Reserve's asset holdings. They help implement short-term interest rate policy decided on by the committee, but do not alter broader financial conditions. These routine purchases are conducted to maintain ample reserves and ensure effective control over short-term interest rates. The pace and size of these purchases are calibrated to meet demand for reserve balances and to adjust reserve supply as other items on the liability side of our balance sheet grow over time. These purchases do not have any implications for the stance of monetary policy. As detailed in the statement released by the Federal Reserve Bank of New York at the conclusion of our December 2025 FOMC meeting, reserve management purchases will be front-loaded for the first few months to alleviate potential near-term pressures in money markets. Thereafter, we expect the pace of reserve management purchases to decline, though the actual size will depend on seasonal fluctuations in non-reserve liabilities and market conditions. In the end, the size of our balance sheet will be determined by the public's demand for our liabilities in our ample reserves regime. Before concluding, let me emphasize that in our ample reserves regime, standing repo operations are a critical tool that helps provide a ceiling on money market rates. By doing so, these operations ensure that the federal funds rate remains within its target range, even on days of elevated pressure in money markets. Consistent with this view, the FOMC eliminated the aggregate limit on standing repo operations in December 2025. These operations are intended to support monetary policy implementation and smooth market functioning, and they should be used by our counterparties when deemed economically sensible. This is indeed what we saw over the 2025 year-end period. There was noticeable upward pressure on repo rates amid substantial net Treasury settlements, as widely expected. Usage increased at the Fed's standing repo operations on year-end as market repo rates increased substantially. Despite the elevated level of repo rates, trading conditions remained orderly in money markets. I am pleased to see increased usage of our standing repo operations when it is economically sensible to do so. To conclude, I will reiterate that I am cautiously optimistic about the path of the economy while acknowledging that we face risks to both sides of our mandate. Consequently, I will continue to watch incoming data carefully so that we can set policy to achieve our mandated goals: maximum employment and stable prices. A critical aspect of achieving these goals is ensuring that the Fed can effectively and smoothly implement monetary policy decisions. We have taken the steps necessary to ensure that capability and will continue to do so. Once again, it has been an honor to be here. Thank you for the opportunity to speak with you, and I look forward to our discussion. Thank you. Okay.
Well, Governor Jefferson, thank you for joining us. Thank you for those comments and sharing the economic outlook with us. I want to just follow up quickly on your comments for the economic outlook. You're talking about the labor market softening and then maybe recovering a little bit. I wonder if you could share just a little bit more about maybe what some of the factors are that cause the labor market to soften or not, and why you think maybe it's solidifying. And maybe you can work in, if you want, maybe the change in the tax regime that's going into effect this year, do you see that affecting sort of long-term growth or your expectations for both where the economy is going and also how we're going to see the labor market, develop or stabilize?
Well, thank you. Okay, thank you for that question. In terms of the slowing that we're seeing in the labor market, I think you can probably point to a number of factors on the demand and the supply side that have caused some slowing. I think on the demand side, what we hear from our contacts is that they feel as though the overall economic environment has become more uncertain. And as a result of that, they are less willing to make significant hiring commitments. They want to kind of wait to see what's going to happen in terms of geopolitical factors, policy factors, domestic policy factors. And so they have described it to us as pausing, okay, that they want to wait and see. So that's on the demand side. On the supply side, we have seen a significant slowdown in the growth of the labor force due to changes in immigration policy, okay, and also some labor force participation. So what we see is not the labor market collapsing or anything, but as I characterize it in remarks, it's just less dynamic than it was, with less hiring and less firing. So we're just sort of hanging in a particular phase as some of the uncertainty gets resolved.
Sure, kind of the wait and see.
Wait and see.
Yes, absolutely. Well, shifting topics slightly here, but kind of hitting the themes of this conference and what many people have been speaking about today, we've been talking about the importance of Federal Reserve independence, whether it comes to policy decisions or how it's structured. And I wonder if you could share how you think about Fed independence, central bank independence in general. Why is that important? What does it allow you to do when it comes to projecting long-term inflation rates and unemployment? So if you could comment on how you think about central bank independence.
Well, I think evidence, real-world evidence and research, it shows that countries that have independent central banks also have better economic outcomes, okay? And so I think that is something that is foundational and sort of shapes my thinking of the importance of independence. But I also feel as though with independence comes the need to be accountable to the public that we serve. And at the Fed, we try very much to be accountable through the information that we release to the public in terms of statements of policy. The chair has a press conference after every FOMC meeting. We release minutes, and over time we release transcripts so people can see what we're doing. The chair goes to the Congress to testify, and every week in terms of our balance sheet, we release the latest balance sheet, and a variety of financial statements are released to the public. And in that way, and through these channels, we are trying to be transparent and accountable to the public. And I think that works hand in hand and comes with the responsibility of being independent. So those two things tend to work together.
Great. So I think, in your remarks, you talked about the Fed's dual mandate, where you're thinking about the price level and inflation, and you're also thinking about unemployment and the job market. The Fed has had this dual mandate for quite a while, and I think people have had a lot of questions, with the bout of inflation that we had recently. And they're wondering a little bit, should the Fed maybe focus on a single mandate with price levels? So could you comment, some central banks do that, but could you comment a little bit on the strengths and weaknesses as you see it of a dual mandate versus would it be better to have more of a single mandate, or how would that affect your decision making as you're thinking about where the economy is going?
Well, I would say that the dual mandate has served the American people very well. And in terms of how we implement or try to address that dual mandate is with regards to our primary interest tool is the setting of the range for the federal funds rate. That's our main policy instrument. And the way we tend to balance that dual mandate with that one instrument is to really think about the risk to both sides of the mandate and think about which one of the goals is the economy the furthest away from at the current moment in setting, and so that matters for our setting about the rate, and also the time it takes to return to our goals based on our understanding of the economy. Now, in terms of what the mandate is itself, that is given to us by Congress, okay? And so we don't get to change that. We just operate with what the Congress has given us. And in terms of what other countries do, I don't have much to say about that, because what I know is that different societies are different. And their authorities have given a mandate to their central banks that is viewed as appropriate and right for their society. The decision makers and elected officials in our economy has said to us that we have a dual mandate, and that has worked well for the American people, and that's the thing that I go to work every day thinking about.
Great. Well, earlier we had some conversation around the Fed's monetary policy framework, how you guys revisit your framework of how you're approaching monetary policy, and you just had that framework updated last year. I wonder if you could talk a little bit about, in 2020, the framework had this idea of makeup policy, or we're going to kind of average inflation targeting. But then the committee sort of moved away from that last year, at least explicit or in their framework. So could you talk a little bit about the idea of average inflation targeting, or how the monetary framework has changed, and what you all are sort of focused on in terms of the trajectory of the price level and where you're trying to get to?
Okay, so you're right. There was a framework in 2020. I was not a member of the committee then, and so I don't want to venture as to what the committee was thinking at that time. But there is good news, okay? Today, this very day, the Fed released the transcripts of the 2020 FOMC meetings, okay? Because the 5-year lag period ended. So if anyone wants to dig deep into the minds of the FOMC as it was constituted at that time in terms of what they were thinking in 2020, have at it, okay? It's posted on our website, all of the transcripts for all of the meetings, and I'm sure there will be many studies coming from that.
I see people pulling out their phones right now.
Exactly. Just go to the link and you can see for yourself. So I can't say any more than what's in that bundle of information. However, for 2025, it was appropriate that we update the framework because things have changed since then. So we went to flexible inflation targeting, leaving out the averaging. And that approach, the flexible inflation targeting, allows us to still keep our 2% objective, but be mindful that we're always balancing both sides of our dual mandate. And so we want to have an approach that says, okay, what can we allow to be true when maybe we're further away from one side of the mandate than the other? And what are the balance of risks in that situation? And that can be a guide to how we're weighting one side of the mandate versus the other. Now, relative to the 2020 framework, the current economy has changed, and we wanted the current framework to be robust, not only to the presence of the effective lower bound, but also to the possibility that real-time assessments of what maximum employment is could be slightly off, and we could have readings of employment above that estimated level that were inflationary. So we have to allow for that possibility, and so you see that reflected in the current monetary policy framework. And there's a statement that says that the committee will act forcefully if long-run inflationary expectations start to drift away from our target. So there are some very important differences between the 2020 or even the 2012 framework, but where we are now is sort of an outgrowth, a logical outgrowth of what came before.
Great. Well, I know there's quite a few financial people in the room who think about bond markets a lot, and you talked about targeting the policy rate, and you guys are more focused on the short-term end. But I wonder if you have any thoughts about bond markets. Does it factor into your thinking at all, or is the Fed mostly focused on, again, the employment numbers and that policy rate? Does it affect much what's looking at the end of the yield curve? Or you mentioned you aren't engaged in quantitative easing, which was more of a yield curve manipulation kind of tool. So I'm just curious how the bond market factors into your thinking, if at all, as you're thinking about the policy target rates and where things are going.
Okay. Well, as a monetary policy maker, I take fiscal policy as given. Okay, that's the provenance of the administration and elected officials, and so I take fiscal policy as given, and then say, given the stance of fiscal policy, what is the appropriate monetary policy to fulfill our mandated objectives?
Great. Well, so we have several students here in the audience as well from FAU. What advice would you give them as they seek to understand economics, the theory, but also just how the economy works? What would you recommend for them as they are learning more about economics? Where should they start? What should they be studying or thinking about to get a better handle on it?
Well, with respect to that, all I can do is convey to you what my experience was, in that I majored in economics as an undergraduate, and the reason I was attracted to it was because econ provided me with a paradigm for looking at the world. I grew up in Washington, D.C., and I was always curious about the wide variety of economic situations that I observed when I was growing up, and sort of what determined one person's outcome versus another person's outcome. And that was something that I was very curious about when I went to college. And so, lucky for me, my first semester in college, I took Econ 1. And I said, wow, you know what? This class has given me a perspective or a lens for looking at the world and making sense of some of the things that I had seen. It gave me a tool for being able to contrast sort of the theory of economics with what I actually experienced in my life. And sometimes there was a a discord between those two things, and that just made me more curious in terms of how the paradigm comported with reality or helped me to understand it, or when it differed from that. And of course, when you start to study economics, it's when the real world is different from the theory that you become even more curious and say, wow, okay, I want to try to understand that. And so that sort of engaged me in the study of economics. So I would say to someone who's doing economic or business or finance that always be looking for the differences between what you're learning and what you see in the real world. And that can stimulate your curiosity and even cause intrigue. And it's a wonderful lens for looking at the world. And if that excites you, then I think that is something that makes the study of business and economics and finance very exciting.
Absolutely. It reminds me of the quip that economists want to know if what works in reality works in theory. Right? Need an explanation for it.
Exactly.
Well, we have time for a few questions from the floor. So I think there's a microphone. If you would like to ask a question, please go ahead and raise your hand, and we will get you a microphone. You've answered all the questions. We've got it up here in the front, right over here, and then we'll go to Kate next, maybe for the second one. Go ahead, sir.
Perfect, thank you. You briefly spoke about the public opinion and how it influences you. You briefly spoke on that when you were talking about the independence. I was wondering, how does it influence your your decisions, your long-held personal beliefs, and also your interests? And do you believe there's a more effective way for these two parties, i.e. you and the public, to transmit their ideas?
Okay, I didn't hear the first part of your question because I don't think the microphone was on. So
there it goes. Is it working now?
Yes.
Right,
yes.
I thought it sounded a little bit weird, but you briefly spoke how the public influences how you think of the public and how they influence you. You said you spoke that during the independence, and I was wondering how do you think the public affects your opinions, your decisions, and your beliefs? And do you think there's a more effective way for the public and you to communicate or transmit your ideas?
And maybe to add on that too, I think part of what he's asking too is how do you maybe listen to the public or try to get a sense of where the public's at in your decision making?
Okay, well, it is very important to listen to the public in terms of how our policies are affecting them. So we do that in a variety of ways. Some are by design. There are various advisory committees to the Federal Reserve Board that are statutory, that we meet with people from the community on a regular basis throughout the course of the year. They come into the Fed and talk to us. Then we have various contact meetings where we reach out to members of the public before every FOMC meeting to see how they are experiencing the economy. And then we have a formal series called Fed Listens, where we hold panels. The Fed has 12 regional districts, and we routinely hold panels where we go out into the country and we invite them to come and speak to us at the regional level on a variety of topics. So we are always listening to the public to try to understand how our policies are impacting them. Now, when it comes to setting policy, the thing that I focus on are the forecasts that we have for the economy, the incoming data that we receive, and the balance of risks, okay? Those are the only things that I focus on in terms of my thinking about what the policy, interest rate policy decisions or balance sheet decisions should be about. So let me stop there.
We have time maybe for one more question back there. Yes, go ahead. Yep, there.
Hi, David Beckworth. I got a question about the standing repo facility, or operations as you now call it. So you expanded the amount, and there's been talk about bringing central clearing to it. Can you give us any updates on that discussion?
Not beyond saying that things are being discussed. Okay, so nothing has been decided on that. We are aware of the different perspectives, and I can only say that these are very active conversations where we're trying to understand, from talking to market participants, what would be the implications of central clearing, and so there are parts of the Treasury market that are already doing that, and we just want to study and understand what all of the different considerations are. So I'll stop by saying actively under discussion.
Great. Well, Governor Jefferson, thank you again for joining us and for sharing your insights in the discussion. Please join me in thanking Vice Chair Governor Jefferson.
Well, everyone, we're getting to the end of our day here. I would like to again thank Vice Chair Jefferson for giving us a delightful keynote, and I absolutely loved his remarks about students and the role of economics in his early days. I think that's one of the best promotions for studying economics, and as an econ geek, I am delighted. Before we break for our wonderful reception downstairs, I just wanted to take a couple more minutes of your time to thank all the people who make an event like this possible. It takes a village, it is true. So I want to thank our partners at the Shadow Open Market Committee, who really were the impetus for us working on this event. They said, let's do something like this. Especially Mike Bordeaux and Mickey Levy. I'd like to thank FAU for not just their amazing campus and venue and hospitality, but the leadership of President Hasner, as well as Dean Gompert, and forgive me, Gropper, and I've got labor laws on the mind. And also, of course, to the staff here who have been tremendous in getting this event together. Special thanks go to Lacey Taylor, who is right now downstairs working on your reception, as well as Monaco Ortego and other of the IT folks who make so many things possible. I would also like to thank a few of my AIER colleagues. Well, Will kind of counts as both. He's AIER and FAU. Maybe one day he'll also be Shadow Open Market Committee. It'll be the trifecta. But thank Will for his leadership on this program and the work that we've done here. But I also need to especially thank Isabel DeSoto, who also is still hard at work at your reception and doesn't even get to hear her thanks, but without her, a lot of these things would not have been possible. And then last, but certainly not least, I would like to thank all of you. Events like these don't happen without people who want to listen, so thank you for coming and thank you for your time. We at AIER put on educational events like this for the public in the hopes that we can share the ideas about economics and, in this case, monetary policy. So we hope you learned something new today and maybe have some more questions. That would be the best thing. And if you do, I encourage you to go visit aier.org. That is our website at the American Institute for Economic Research. So without further ado, let me not come between you and a lovely reception. I invite you to join us downstairs, carefully, downstairs for a reception. And thank you again. And I've almost forgot. And our panelists, please. Thank our panelists. They might be the most important thing. We really wouldn't have